A lot of the reasons why Germany and Europe is rallying, and even China, was because the Mag 7 is really underperformed.
It's earnings that's really going to drive the market this year. We think the market's ending around 6,600.
The potential for a growth scare is sadly for real. Hard to see the market moving up 10% from here.
More and more investors would rather own big tech. Obviously, there's regulatory risk, but that continues to be, I think, at the top of the mountain when it comes to AI revolution.
There's still a lot of uncertainty, fear, and doubt for good reason.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday on a 4-day slide on the S&P 500. Your scores look like this. On the S&P, equity futures bouncing back by 0.5%. On the Nasdaq, up by 0.8%. The Mag 7 stocks down 10% from all-time highs. Teeing up the big one a little bit later on this afternoon. Earnings from NVIDIA.
A lot of questions here that they have to answer from DeepSeek and what the application will be, whether that reduces some of the desire for their chips. A lot of people are wondering, is demand still insane? And the rock star in the leather jacket's going to have to come out with some really interesting superlatives to change this fear that's been invading markets.
Attention will turn to the earnings this afternoon. Before we get there, we still need to talk about the economic data. We've had a basket full of weaker than expected economic data. Yesterday, consumer confidence lower, the biggest drop since August 2021, below all estimates on Wall Street.
Everyone seems to be worried about the economy right now. And when you hear from the conference board what they said when consumers are called up and asked about how they're feeling, references to inflation and prices in general continue to rank high and write in responses, most notably comments on the current administration and its policies dominate the responses. And then you hear from corporate America. And what you hear is a consumer that's hesitant right now to spend. It's on pause.
Feeding a 5-day move in the bond market. Yields lower across the board for 5 consecutive days. A 25 basis point move lower on a 10-year maturity. Yields this morning higher by 2 basis points. Lisa, 431.
So this to me is a fascinating push-pull. On one hand, you have fears of some sort of negative growth shock to what you were talking about, Anne-Marie, with consumer confidence falling the most since August 2021. And people who are saying that jobs are plentiful versus hard to get falling to the lowest since October. It definitely is a weakening trend. On the other side, you have a budget. And you have something that was passed in Congress that basically paves the way for $4.5 trillion of tax cuts that are offset to the tune of about $2 trillion of cuts elsewhere, but additional spending in other parts. The story that the deficit is expanding is not going away. And that really is the push-pull in bond markets right now.
Jake Sherman called this budget passing last night one of the biggest success stories Speaker Johnson has had. But now the hard part starts. It is going to be weeks, months of wrangling between Congress and the Senate to get this over the finish line. But you know why? I think a lot of people will see what happened last night and think this actually does get done. Amongst all these holdouts, only one ended up voting no in the end because they kept the vote open for hours. And what did they do? Donald Trump was calling from the Oval Office and said, I'm going to need a yay on this.
They've got to move quickly. They've got to do something about the inertia that's taking hold of consumers in America. Sentiment softer, retail sales were weaker. We've seen the outlook from Walmart, from Home Depot. We heard from 2 banks yesterday, Bank of America and BMO, suggesting that to a certain extent, clients are just sitting back and they're in wait-and-see mode.
Remember a couple months ago when we were talking about how this would be the year of the boom in deals, that we would get suddenly this M&A crashing wave that would overwhelm all the activity? It has not been there. And a lot of people are saying it's because of a lack of certainty. A key question about whether this budget will be enough, if it does get passed, to really overwhelm some of the concerns about tariffs, et cetera. Again, that push-pull. And that's sort of what Neil Dutta was talking about. How much are people using the tariff talk to justify some weakness that was creeping into the economy even before some of those discussions?
On your time this morning, equities too were up by 0.5% on the S&P 500. Joining us this hour, Keith Lerner of Truist, downgrading stocks to neutral. Brian Gardner of Stifel as the House paves the way for tax cuts. And Yelena Shulyatyeva of the Conference Board as consumer confidence rolls over. We begin this hour with stocks looking to snap a 4-day losing streak. Traders are waiting NVIDIA results after the closing bell. Keith Lerner of Truist downgrading equities to neutral, writing, we have seen modest deterioration in earnings, technical and economic trends that warrants a more neutral equity posture and slightly higher cash. Keith joins us now for more. Keith, welcome to the programme, sir. Always good to hear from you. We've had a 10% correction on Mag 7 names. Why isn't that a dislocation and opportunity for you and the team?
Yeah, well, great to be with you. You know, Jonathan, our overall call is broader for the overall market. We've been big bulls over the last year. We really follow the weight of the evidence as just mentioned. And the weight of the evidence has shifted more to a mixed backdrop, and we're making that shift. And we made that shift earlier this week. So let me just walk you through a couple of things that we're looking at. And keep in mind, the S&P 500 is only about 2 or 3% from an all-time high. But the first thing is, you mentioned earlier, the economic data. At least we're seeing a little bit of softening. We all know the economic surprise index is now the lowest since September. So on the margin, we've seen, the economy slow down somewhat. At the same time, a key pillar of this bull market has been the resilience of corporate earnings. And what we have seen over the last month is the forward earning estimates for the S&P 500 start to move sideways. Now, that may be a pause that refreshes, but that is on the margin a shift. And then on the technical side, even though the market just made a new high last week, below the surface, we only have about half of the stocks in uptrends as defined by the 50-day and 200-day moving average. So we put that all together, and with the Fed likely on the sidelines, kind of boxed in here, when we're seeing some fiscal tightening, we just say, hey, we're not saying this is catastrophic, but we are saying on the margin, a more neutral posture at this point makes a lot of sense to us.
Keith, does it change anything about how you see the world 12 months out? I think we all need to skate where the policy puck will be in about 1 year from now. It won't just be about trade. It'll be about deregulation. It'll be about tax cuts. Has the 1 year view changed at all?
Not that much. But after the election, and our thought back then was the market was all focused on all the positive aspects of the perceived positive aspects of the Trump administration, as far as like what you mentioned, tax extensions, deregulation. And we thought earlier in the new year, we'd at least see some more focus on tariffs. Now it seems like we're only focused on the tariffs and the negatives. And I think as we move later into this year, that there's a potential that we will see some type of jolt to the upside as some of this uncertainty gets unlocked. And there is a more focus on these kind of positive aspects. And I will say also on a short-term basis, some positive offsets. We are seeing, as you mentioned, the 10-year Treasury yield come down about 50 basis points. Oil prices have come down. The U.S. dollar has come down. So financial conditions are easing somewhat as an offset. But again, I think we have to get through this kind of event period near term into March and April, and probably closer to the summer, so to the market starts focusing on some of these more positive aspects again.
Keith, you mentioned that you don't think that the Fed is going to be in play for most of this year, and that's one of the potential headwinds to S&P outperformance. And yet, as we get some of this negative economic data, you see 2 rate cuts being priced in through year end. If that continues to build, that kind of sentiment, would that change your view on equities?
Yeah. So just to be clear, we think we are in the 2 rate cut camp this year. We think it's likely more in June. So when I said the Fed's boxed in, I think it's more near term. That even if the economic data weakens near term, I think the tariff uncertainty is going to keep them on the sidelines unless we see a more significant move down in the economy, which if that happens, even if the Fed cuts rates, I don't think that's going to be a great overall backdrop for equities if the economic growth outlook is also deteriorating. So I'm basically saying that they're boxed in, I guess, in the first half to a certain extent. So they're not going to come to the rescue right now. I mean, eventually we do think that the inflationary trends will start to come down that will allow them to cut rates later this year. But again, it's not something near term where we think that we're going to see a big posture shift in the Fed.
Meanwhile, Keith, you were talking about how one sort of plus has been that the 10-year yield has come down, and that's offered a bit of accommodation to the broader market. I wonder how sustainable you see that. We have seen this negative economic data, but on the flip side, yesterday, we got a $4.5 trillion tax cut potentially in the works, and a lot of people have been expecting that. At the same time, deficit concerns come back to the table. At what point do you think this push-pull is going to keep the 10-year kind of in this range versus continuing to drop?
Yeah, we think it's more likely to stay in a range. We thought at 480, things got a bit hot. I think on the downside of the 10 years, probably about 410. So maybe right now closer to fair value. So I don't know that there's a tremendous amount of downside. But if you remember back in early January, the market was having difficulties because there was concerns that yields were going to go to 5% or 5.5%, and now they've come back down. So, to kind of zoom out a bit, I just think that we're going to have more of this, back and forth, and again, probably moving closer to fair value, maybe a little bit more downside on the 10-year, but not substantial from current levels.
Keith,
and one thing too, the yield curve though. Look at the yield curve. I mean, that's the other thing. Just going back to the growth aspect, we're starting to see that flatten quite a bit.
Keith, to John's earlier point, if you take a long-term view, would you be where you are today, say if the sequencing was swapped? If we didn't really hear anything out of the executive branch about tariffs, but we just got, to Lisa's point, this budget passed last night that is the starting gun for massive tax cuts, or at least the extension of TCJA.
Yeah, and I think that's part of the reason why I invest, even though we're moving more neutral, I think if I had the question to say, why not even become even more negative? I think those things are out there. I think the president also is focused on the economy. He doesn't want to have a recession in the first year or even in the second year and focus on the stock market. So I think there's going to be some inherent buffers against this market moving too low. But even if I take away what's happening in Washington, because it's such a frenetic pace, there's so much noise, I go back to our weight of the evidence approach. We're seeing earning estimates start to move sideways. We're in an economy where valuations for the market are already at the high end of historical levels. So if we don't have earnings moving up in a meaningful way, it's hard to say we're going to have a big upside to the overall market. At the same time, the economy is becoming a little bit weaker on the short term, and we're seeing a split market below the surface. So those are the indicators we're looking at to try to deal with all the frenetic news that's coming out of Washington to stay focused on what matters.
So when you see this uncertainty, as the consumer's hesitant, the stock market has a bit of angst, you say you have slightly higher cash levels. What else do you think you should be doing?
Well, I think at some points, I think part of this is to be patient and not to be driven so much by the day-to-day headlines. The other thing that we've done, for the last year, I mean, we have been overweight large caps relative to small caps. We have moved small caps even one notch down again. And the reason being, in that backdrop, normally small caps need an accelerating economy to outperform. We're seeing some deceleration, at least short term. Again, some softening and cooling. At the same time, if the Fed is going to keep rates higher, at least to the middle of the year, these small cap companies have a lot of floating rate debt, so they're not going to get that relief. And on our work, we've seen a 52-week low on relative price trends to large caps, and relative earning trends have just broken down as well. So that's another area we would remain more cautious.
Hey, Keith, appreciate the input. Thank you. Downgrading equities over at Truist. Keith Lerner there with the latest. Let's talk about the latest, both the earnings and the data. Yesterday, consumer confidence came in a little bit softer in the past few weeks. Retail sales weak as well. If you look to the earnings, we've had outlooks from Walmart, from Home Depot. Both of those just a little bit tepid, worse than expected. Just got lows moments ago.
Yeah, and sounding a similar type of line that's saying that total sales for the full year are going to be below what the street was expecting. Again, uncertainty about near-term home projects, et cetera, whether people want to do that based on mortgage rates, whether people want to do that based on lumber tariffs or whatever else. Is this them setting a low bar that they can then leap across later? Or is this indicating a true feeling that maybe things are shifting in a little bit of a shaky path?
I think we're all sitting here waiting for clarity on the outlook for policy. Equity futures on the S&P, a better story to tell this morning, bouncing back by 0.5%. With an update on stories elsewhere, with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. Starting in Washington, D.C., House Republicans have passed a budget blueprint that would make deep cuts to safety net programs like Medicaid. It tees up $4.5 trillion in tax cuts. The measure passed with a 217 to 215 vote along party lines, with just one Republican opposing. The bill now heads to the Senate, where more changes could be made. Elsewhere, Ukraine has agreed to a deal with the U.S. to create a joint fund to develop the country's natural resources, including critical minerals, oil, and gas. The deal does not spell out future security guarantees for Ukraine, but it may help ease tensions with President Trump. Ukraine's President Zelensky is set to visit Washington on Friday. A check on Stellantis shares. Those are falling some 5% in the Italian trade. The automaker offered a lackluster forecast for the rest of this year. Muted demand for cars in Europe and tariff threats are weighing on the company. Stellantis said it will evaluate share buybacks and expects to generate positive free cash flow in the second half of the year. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. It is so difficult to offer guidance right now. 12 months out, 24 months out. The Fed's got to do just that in about 2 or 3 weeks' time. They've got to put out a new dot plot and put out new forecasts.
So at a certain point, you have to wonder what the usefulness of this is and whether they're just exposing themselves to political accusations if they say anything. If they just gave us a blank sheet of paper and said, your guess is as good as ours, or a big target with a picture, pick your own adventure, I think that probably would be maybe advisable.
March 19th, a few weeks away. Up next on a program, delivering on Trump's agenda.
This is the first important step and in opening up the reconciliation process. We have a lot of hard work ahead of us, but we are going to deliver the America First agenda. We're going to deliver all of it, not just parts of it, and this was the first step in that process.
The tax cuts just around the corner. We'll catch up with Gardner of Stifel for his view in just a moment. Live from New York City this morning. Good morning. Four-day losing streak on the S&P 500 over that period, down about 3% on the S&P. A similar move on the Nasdaq 100, but over the same period, down about 5, down almost 5 percentage point. The pain has been in big tech. We'll hear from big tech a little bit later. Nvidia reporting after the closing bell. In the bond market at the moment, yields are higher, up by 2 basis points, 431.74 after 5 days. 5 days of lower yields, a move of around 25 basis points. Under surveillance this morning, delivering on Trump's agenda.
We had the requisite number of votes to move this process along, and now passing the budget resolution in the House that will go to the Senate. This is the first important step in opening up the reconciliation process. We have a lot of hard work ahead of us, but we are going to deliver the America First agenda. We're going to deliver all of it, not just parts of it, and this was the first step in that process.
So here's the latest this morning. House Republicans just about passing President Trump's one big, beautiful bill. Now it moves to a showdown in the Senate. Bloomberg's Tyler Kendall joins us now from the nation's capital for more. Tyler, what's next?
Well, John, good morning. This was a key early test, but there is still a lot of work to be done. And to be sure, President Trump had to make a flurry of phone calls last night in order to get this over the finish line. When we look at the details of this House plan, it calls for up to $2 trillion in spending cuts. That is not enough for many fiscal hawks, although we are learning that they have been promised more spending cuts could be tied to a House bill to keep the government open ahead of a March 14th deadline. Now, within those spending cuts, this plan directs the committee that oversees Medicaid to find $880 billion worth of savings. If just for the sake of the exercise, all of that went towards slashing Medicaid, it would cut the program's annual budget by 10% over the next 10 years. So a political fraud issue that Republicans are going to have to deal with going forward. And then just lastly, John, is the tax fight. This is where we are expecting the most friction when it comes to the Senate. This plan calls for $4.5 trillion in tax cuts. That's likely only enough runway to extend President Trump's 2017 tax plan. That means many campaign promises like no taxes on tips, overtime pay, Social Security, lowering the corporate tax rate for companies that move production to the U.S. That all could be left on the table if Republicans can't find more pay-fors.
And of course, the biggest fight is going to go down to TCJA in terms of should they be made permanent. That is what Senate Republicans want to do. Tyler, how difficult is this process going to be between House Republicans and Senate Republicans?
Well, we got a little preview from the Senate Budget Chair, Lindsey Graham, last night, who said that this bill is neither big nor beautiful when it comes to tax cuts. We are expecting them to move these requirements that the House has put forward around, and the White House is expected to be heavily involved. We are expecting House and Senate Republicans to make their way over there later today, and we've also learned that Treasury Secretary Scott Bessent is starting weekly meetings up here on the Hill to try to figure out how they can negotiate this forward.
Hey, Tyler, appreciate the update. Tyler Kendall there from the nation's capital in Washington, D.C. Joining us now, Gardner of Stifel, to build on the conversation. Brian, welcome to the programme, sir. For people just waking up this morning who aren't as familiar with the process as you and Tyler are, can you walk us through on where we are at the moment and how much longer this might take?
All right, so it's spring training for baseball. Let's put it in baseball terms, right? In terms of a 9-inning game, we're in the first inning. It's that clear. It is very, very early in the process. This was an important step last night. It was a prerequisite for the rest of the debate that's going to play out through the rest of the spring, maybe into the summer, maybe into the fall. But we are really early in the process.
Given it's so early in the process, what does it say to you that to get over the finish line, we had to have President Trump act like the Speaker of the House, basically whipping votes last night?
I think that's a rhetorical question. I think you kind of answered it yourself. The fact that what should be a fairly easy vote just to get the process started and moving was essentially root canal last night. And very, very difficult to get enough votes to switch from no to yes. And it kind of belies the difficulty that is going to be down the road. Because among the yeses were a lot of members who have concerns over the Medicaid cuts, the potential Medicaid cuts. There's nothing formal in the bill yet. But they've been speaking to the leadership, to the White House. Their concerns are out there. And if those Medicaid cuts start to materialize and become part of actual legislation, those yeses are really at play. And on the flip side, as the report just mentioned, the fiscal conservatives, they went along with it, but they want more cuts. Well, if they get their more cuts, then you're going to lose some of the other yeses, like I just mentioned, who are concerned about the deepness of the cuts. It's a very difficult, the political calculus is very, very difficult.
And they have a razor-thin majority. When you talk about those...
Like we saw last night. Yep.
Yeah, when you talk about these Medicaid cuts, it's not outright that they're talking about Medicaid, but we're talking about $880 billion that comes from the Energy and Commerce Committee. What else could it be if it's not Medicaid?
And that's the issue, right? So for people who don't understand, last night, what they voted on just has top line numbers. There's no legislative language. There's no policy language in that document. But it assigns $880 billion in savings to the Energy and Commerce Committee. Well, you look at the Energy and Commerce Committee and see what their jurisdiction is, and you get to Medicaid. Now, where can you find offsets elsewhere, maybe even outside of that committee? And what I have pointed out to clients is that when you look at the tax cuts, there may be some tough decisions coming down the road on maybe some items not being extended, or some current policies such as maybe a cap on the corporate SALT deduction. Maybe that comes into play. Maybe a stock buyback tax, which is already in law, maybe that gets increased. So there's going to be very intense negotiations that have market impacts over the next couple of months.
Brian, the estimate from the Committee for a Responsible Federal Budget says that this current proposal will increase the federal deficit by nearly $3 trillion over the upcoming years. Is that the base case for you going forward, that this is essentially how much any kind of bill will increase the deficit?
Roughly. And I think one thing that is happening, which I think is a positive, is that we're getting back to a more sustainable trajectory on debt. Debt's not going to come down. We're certainly not getting to a balanced budget, but we're getting back to an historical norm, which has really we've been out of kilter with that during COVID. And I think Scott Bessent mentioned this in your interview with him earlier in the week, which was absolutely fantastic. Just getting back to a sustainable trajectory on debt and deficits, and then dealing with longer term problems after that, because longer term problems, longer term debt solutions have to include Social Security and Medicare, and those are off the table for right now.
Brian, when's the World Series? October.
October.
Yep. Okay.
Brian, yeah, the speaker and the leadership, they had a big win last night. Let's not diminish that. They've been talking about a very aggressive and ambitious timeline of having this all wrapped up in the spring. I've always been a little bit skeptical about that. If they can do it, hats off to them. It would be an enormous accomplishment.
Spring training.
Because of the negotiations that are going to go on, I think we're going to go on into the summer. And I think, Jonathan, we can be back here in September looking towards the playoffs at that point and still be talking about this as it gets closer to the finish line at that point.
Brian Gardner of Stifel. Brian, appreciate it, sir. Thank you. Still very early days in baseball terms.
Very, very clever, John. Bringing it full circle, bringing the game to the ninth inning where we can really see the final potential shot.
You have to wait till year end. I remember some very aggressive timelines coming out of the election in early November. People were thinking in the spring we could have it as soon as then. It's going to take some time.
If it does, what does that do to a market that is getting accustomed to what can get done quickly versus what's going to be something more of, the whole season, which is a lot of games, let me just tell you.
There's way too many games, aren't there? Yeah, it gets tedious.
Yeah,
my view. I love baseball, but it gets tedious sometimes. Up next, Yelena Shulyatyeva of the Conference Board on consumer confidence in America. The big one comes a little bit later. Earnings from Nvidia after the closing bell. Going into that 4-day losing streak on both the S&P and the Nasdaq. We're down on the Nasdaq 100 over the past 4 days or so by around 5%. On the S&P 500, down around 3 percentage points. Equity futures bouncing back this morning by 0.5. On the Nasdaq 100, we're back up by 0.76%.
So to me, this is really going to be either the prove it or not question with NVIDIA. Are they going to show that demand is still, quote, insane, and there still is an overwhelming desire to buy chips that they can't produce quickly enough? Or are you seeing that sort of tepid demand start to bleed in on the heels of DeepSeek? If that confirms that narrative, do we see this ongoing underperformance of big tech?
Over at General Motors, seeing an overwhelming desire to buy their own stock. This headline just drops. The board approving a new $6 billion share buyback. The board approving a new $6 billion share buyback. GM is up in a pre-market by 1.5%. The CFO with this to say, the company will be agile in response to public policy changes. I think we know what he's talking about.
So we were talking earlier about the significance of some of these auto companies and how they can potentially maneuver ahead of tariffs. This one is an interesting one. And I'm trying to understand, is it basically a vote of confidence in their own shares saying that we'll be able to maneuver? Is it saying, look, stick with us and we'll give you a little bit of a sweetener? So come on, come along for the ride, even if you think that we're unbuyable. It sort of raises an interesting timing question.
Remember, they came out with a decent outlook and the market didn't believe it and sold the stock. The stock is down by more than 20% from the highs of November last year. Then this is the company saying we believe in a plan, believe in the outlook, and we think our stock might be undervalued here, so we're going to buy back more of it, $6 billion worth. Some people might sit here and say, the bear's out there, this is a terrible time to be doing share buybacks. Wait to see what happens with policy, because you could see a very, very different industry for these names.
If you have to transform some of your supply chain, you're going to want some extra cash on the sidelines. For them doing this, they're saying, look, we have enough confidence in what we're doing that we're going to give you a sweetener to stick with us. Let's see if it sticks in the stock price.
Those two headlines from General Motors this morning. The board approving a new $6 billion share buyback. The CFO coming out and saying the company will be agile in response to public policy changes. The stock is higher by close to 2%. Let's finish on the bond market. Check out 2s, 10s, 30s. What a move we've seen over the previous 5 days. 5-day move, 25 basis points lower on a 10-year yield. This morning, we're up to your 10-year, 431.55.
A lot of people are talking about growth fears, and that's confirmed by the negative economic surprises and really consumer sentiment that's been falling off in a significant way. And it's not because of current conditions, it's future conditions. And it's not just future conditions with respect to pricing, but yesterday, it's future conditions with respect to the labor market. We have to go back to a question that we were asking extensively last year. Is this normalization or is this true weakness? Because some of this is just going back to levels that we've seen during relatively normal periods. And that ultimately has to be a question as people get carried away with maybe the recession is upon us.
Are things cooling or are they cool?
Exactly. Thank you.
We've been debating that for quite a while, haven't we?
Yeah, that was very well done, yes. It's been a long baseball season of analogies.
Baseball season hasn't even started yet properly, has it?
We're still on the last year's
season.
Training.
Spring
exactly.
training,
Yeah, but it's, it carries over the whole year.
Bond yields are higher this morning, up by 2 basis points, 431.55. We'll talk about consumer confidence more in just a moment. Mitch was easier to ignore. The conference board is harder to ignore. On our radar this morning, Nvidia reporting its highly anticipated fourth quarter earnings after the closing bell. Investors eager for an update on AI spending in the wake of Chinese startup DeepSeek's low-cost breakthrough in the past month.
So there are a couple of questions here about demand, about how much companies are questioning their investment as a result of some of the efficiencies. A larger question will also be about how their customers are deploying the technology. Is it revolutionary in the same way that was expected? And if they cannot show profit gains from using some of their chips, is there going to be the same kind of demand going forward in the future?
I'm curious to know what he has to say about what kind of chips he thinks was maybe used when it comes to DeepSeek and that large language model. What kind of chips were used? Because you're probably going to see a lot more export controls, similar to what we saw under the Biden administration, carried through to the current Trump administration. Were
they export compliant? The company at the time said it was. I think there'll be some questions on all of that a little bit later. Nvidia's positive in the pre-market, up by 2.4%. Down in Washington, D.C., House Republicans just about passing a budget blueprint for President Trump's agenda. The measure calling for deep cuts to safety net spending programs like Medicaid that would pave the way for $4.5 $2.5 trillion in tax cuts.
217 to 215. I mean, this is as close as you can really get when it comes to how they were able to get this over the finish line. And I was only half joking. It felt like President Trump last night was actually the speaker whipping the votes. That's the only reason why this budget got over the finish line, and it is only the first step. So to Brian's point, this whole idea of spring training, to your point, there are going to be months until the World Series, and there's going to be a ton of back and forth between congressional Republicans, Senate Republicans that do not see eye to eye on a lot of the basic provisions of this reconciliation process.
And it raises real challenge to the idea of no tax on tips and, frankly, increasing the SALT tax deduction, given the fact that this is not including any of that. This is just the extension of existing tax policies for companies. That, I think, is very much on the table at a time where the deficit's already increasing by $2.8 trillion with this current proposal.
For the mood of the market, sequencing matters.
Yes.
And at the moment, sequencing is good for bonds and bad for stocks. Let's see if that turns around by the end of the year.
Essentially, some of the sweeteners are not looking as feasible as some of the sticks when it comes to tariffs and other measures.
So here's another one for tariffs. President Donald Trump signing an executive order to examine tariffs on copper. Administration officials saying the levies would address a national security issue. Trump already slated to impose 25% tariffs on both steel and aluminum that take effect in just a few weeks' time.
So what's another metal added to the list? Last night I was looking at the fact sheet, and Trump was talking about that he recognizes an over-reliance on foreign copper, and they could jeopardize U.S. defense capabilities. It's about shoring up supply chains. But obviously this has to go through countries that they think are dumping on the global stage, and also the fact that the processing is really dominated by China. All roads lead to Beijing at the moment when you look at a lot of the tariffs that are actually in place or they're thinking about putting in place.
Late last year, I was in Peru. And a lot of the miners there were talking about how China's making a huge investment in South America, in their copper mines, in their other metal mines, because they have huge amounts of resources. And that's actually the number one exporter to the United States. That's where the U.S. gets most of its copper. How do you shore up those supply chains while also sticking more blanket tariffs? And these are some of the questions they're going to have to parse out. Maybe they're trying to punish Beijing, but in the meantime, are they going to strengthen some of the ties between China and some of the big producers?
All roads lead to Arizona. There is a joint venture between Rio and BHP, the Resolution Copper venture, which has been held up in courts for more than a decade, been held up by politicians across administrations for more than a decade. And if they did something about it, if they managed to approve it, you would have a copper deposit there that could meet 25% of annual copper demand for this country. So, yes, LATAM's important, it always is, particularly Chile, and Chinese demand's a massive factor too. But we have the deposit right here in the United States.
And I wonder if this is going to get fast-tracked under Trump administration, because he's talking about if you bring manufacturing to the United States, if you invest in the United States, the process to get through regulation is going to be that much easier. This is something that potentially maybe we finally see a lot more work get done when it comes to Resolution Copper. But for years, this has been pretty much on the sideline because of issues when it comes to environmental concerns.
We spoke to Rio, and Rio was excited about the prospect of maybe that story changing, and let's see if it does. Let's turn to the economy. US consumer confidence seeing its biggest drop in nearly 4 years. The Confidence Board writing consumers became pessimistic about future business conditions and less optimistic about future income. Yelena Shulyatyeva of the Conference Board joins us now for more. Yelena, good morning.
Good morning.
Now, I respect the data, but the Conference Board consumer confidence figure doesn't usually move markets as much as it did yesterday. People are nervous, and they're nervous about where the consumer is at the moment. What's your read on things?
I think probably the market move comes after both the Michigan survey and the consumer confidence survey both showed the same thing. So that is telling you the issue is a little bit more broad-based. So I think, the important thing is that expectations fell quite significantly. And what concerned me in that survey, in that particular survey, is that consumers are expecting fewer jobs available 6 months from now. So that is probably at the highest level in more than a decade. That index is telling me that, consumers don't see much availability in the job market. So we know the turnover is lower than it used to be. So, when you get laid off, when you get fired or whatever, you are finding fewer and fewer possibilities, and consumers are concerned about that.
What's the difference between normalization in the economy and outright cooling?
So we expect normalization. So this is something like 2% growth in GDP by the end of the year. But if we see tariffs, and this is something we model at the conference board, we see quite a big hit from the tariffs if we get a combined impact from China, Mexico, and Canada tariffs that have been discussed of about 1 percentage points on growth. So that would be a significant slowdown to a stall speed, in the economy of around 1%. So that would be a disaster, actually.
The reason why I ask is because on one hand, you could say these numbers are pretty negative. All right, go to cash, sit in your mattress. On the other hand, you could say we've actually been in a really robust growth kind of scenario with jobs being created in a significant way. And actually, this reduces some of the inflationary risk that we had heard about maybe late last year. Why is it the former more than the latter?
So I think these numbers are not catastrophic, the numbers that we saw in the conference board survey, because they're still in kind of a range, the bottom of the range, but still within a range that the index has been over the last several years. And over the last several years, what did we see? We saw consumer spending at quite a solid rate. So the problem here is that the decline in confidence comes at the time when the savings rate is at a very low level at 3.8%. This is very low by historical standards. And what usually happens when confidence declines, the savings rate starts to increase. And, when your income is the same or even declining because of inflation, that means only one thing. And that thing is the decline in consumer spending. Consumers have always been the driver of economic growth. And at the time when we rely on consumers so much, that means a slowdown in economic growth.
One of the big criticisms of the University of Michigan survey is that it's very political. How much political bias do you think is in the conference board survey?
Absolutely, that has the same issue. And if you look at the breakdown by political party, obviously Democrats are more pessimistic, even independents are more pessimistic than Republicans. But even in this, the conference board survey, the Republican sentiment is actually leveling off as well. So we saw it across the political spectrum in this survey.
When it comes to the write-in responses, I love these because you get a sense of what's going on in people's minds. They talk about inflation and tariffs. Is anyone talking about the fact that there might be a tax hike if TCJA wasn't extended? Is that concerning any consumers?
I don't think we're there yet. So what we see in the write-ins is the increase in policy concerns, in political concerns, in tariffs, yes. So those things that we hear on the news every day. Inflation is still a big concern, but it's being kind of like replaced by all this political agenda that we're hearing. I don't think the taxes are on the agenda just yet.
Yelena, always good to catch up. It's good to see you.
My
Appreciate it. Yelena Shulyatyeva there of the conference board, the latest on consumer confidence. It's interesting. You ask people how they feel about the economy, and we've had 2 reads on that in the past week. Ask people how they feel about the policy, and the policies are actually really popular. Do you see the Harvard poll in the last few days?
Policies are really popular.
Really backs up that idea that people out there really support what this administration is doing.
They're supporting the rhetoric, especially when it comes to things like immigration. Trump maintains that actually his team would say he won the election on inflation. He thinks he won because of immigration. And you have to think, people are concerned about tariffs. There's only one policy when it comes to tariffs that is actually in place. Tons of talk, tons of rhetoric, a lot of bark. Only one thing had a bite, and that's the 10% on China.
76% support a full-scale effort to find and eliminate fraud and waste in the government. 63% support freezing and re-evaluating all foreign aid expenditures in the department that handled them. 61% support reciprocal tariffs. It just goes on and on in that release in the past few days.
We talk about DOGE, and even though there is some question around it, unless you're losing your job, a lot of people like the idea of it. Question is, down the road, if there are significant cuts to Medicaid, and that, I think, was what some of the concerns were by some Republican members who pushed back. Do people start to feel it in a different way? And it sort of makes it real in a different way than some of what these polls are showing.
What's that old saying? If it's your neighbour, it's a recession. If it's your job, it's a depression.
Well, exactly.
Something like that.
Exactly.
Yeah.
I mean, it makes it a little bit more difficult when you personally are getting affected.
Equity futures right now positive by 0.5% on the S&P. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Elsewhere in Washington, D.C., President Donald Trump says that he's starting a new path to U.S. citizenship. The president said that the U.S. will sell gold cards for $5 million to foreigners who create jobs. He said the plan would launch in 2 weeks, and he doesn't think that it needs congressional approval. A check on GM shares this morning in the pre-market, up nearly 4.5%. Moments ago, the company announced a $6 billion share buyback. GM also raised its dividend by 3 cents a share to 15 cents. The announcement does come, though, as the auto industry faces uncertainty about President Donald Trump's threatened tariffs and pledges to roll back support for EVs. Let's also take a look at Lowe's shares in the pre-market. Those are up by 2.33%. Its fourth quarter earnings beat estimates. Adjusted earnings per share and net sales both came in above expectations. However, Lowe's did forecast lower than expected sales growth for the year. There's still uncertainty over home improvement, with consumers having stayed on the sidelines with big housing projects. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, bonds surging.
There's really three things that have driven this drop in yields. The first one is the realization that the global trade war is not going to come to fruition. We're right now in the midst of what I call a seasonal slowdown. There's a realization that the worst case scenario on Treasury supply is temporarily off the table.
That conversation up next. We'll catch up with Jim Bianco of Bianco Research, get his thoughts on the bond market move of the previous 5 days and the last 6 weeks for that matter, and why he thinks there could be a so-called Mar-a-Lago Accord. That conversation up next. Equity futures positive this morning. Stocks up by 0.5%. Nvidia up in a pre-market. We're higher by 2.3%. Under surveillance this morning, bonds surging.
There's really three things that have driven this drop in yields. The first one is the realization that the global trade war is not going to come to fruition. Worst case scenario is not going to play out. Point number two, we're starting to see now is really filtering into the bond market, and that is the realization that we're right now in the midst of what I call a seasonal slowdown. Point number three is that there's a realization that the worst case scenario on Treasury supply is temporarily off the table.
So here's the latest this morning. Traders hedging for a potential economic slowdown with yields sliding to their lowest level of the year so far. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the program. We've got a lot to cover. Let's start with the bond market. 6 weeks of gains into this week, lower yields across 6 consecutive weeks. For the 7th week, we're seeing another week of lower yields. Over 5 days, 25 basis points. Jim, let's start there. What's behind that move?
Oh, I think the big thing that no one's really talking about is what's been happening in Europe around Ukraine. The president is trying to cut a deal. He wants Europe to pay for security, which is a big part of that Mar-a-Lago Accord. And they can't run to their parliaments fast enough to lift debt caps, say they're going to increase by trillions of dollars over the next 10 years their budgets for defense, which filters back to the U.S., then we don't maybe need 60,000 troops in Europe. Maybe we need 40 or maybe we need 20. And the idea is maybe we've got some kind of debt relief coming or some kind of deficit relief coming. That's what has changed in the last week to 10 days or so, is this idea that Europe is very open to relieving us of a lot of the defense spending burden that we've had. And I think that bonds are responding to the potential of lower supply. Now, whether that happens, that's for later this year. And whether or not that will be stimulative or inflationary, that's for later this year. But right now, I think that's been the catalyst that's changed us in the last week or 10 days.
Jim, you brought up Mar-a-Lago Accord, so let's go right there. You basically have been holding meetings telling people that they have to think about this type of scenario where this administration looks to allies and says, buy longer-term bonds at certain specific yields, and then we'll give you certain guarantees or deals, et cetera. It's sort of a different way of trying to shore up the deficit. A lot of people have really shot this down, saying absolutely not. It would decimate the market, treat it like an emerging market. What makes you think that there is anything feasible about this whatsoever?
Because that's not the plan. Everybody's got that backwards. That's a payment opt idea is all that was. That's like whether or not you want to use a paper check or Zelle. What the Mar-a-Lago Accord is tariffs, a sovereign wealth fund, and payment for security. And we've gotten all three of those. And within payment of security, there was the idea floated of a bond swap. Okay, you don't like the bond swap. They're still going to spend trillions of dollars on security so we could then relieve ourselves of the burden. That's what the whole point is. And that, everybody's gotten hung up on this one aspect about payment of security. Maybe it happens, maybe it doesn't happen. But the larger issues of all of that are happening. Now, why are we doing this? The idea is to reorient the world global trade system, which we seem to be trying to do with tariffs, to bring down the value of the dollar, to bring down interest rates, and to make the U.S. more competitive. That's what the goal is. Now, at this point, it looks like all three aspects of that are underway and happening, and we shouldn't just get bogged down in just one idea about a payment mechanism and call that the entire plan.
When it comes to weakening the dollar for this administration, what trading partners is it so important against?
It's a very good question, because if you look, there's two types of dollars. The Federal Reserve has what's called the trade weighted dollar index. That's been going straight up because it's weighted by trade, and Canada and Mexico are the biggest players there. The dollar index, which we all look at, you quote every day, that's weighted by more like flows, and half of that is the euro. So really, when you talk about trying to weaken the dollar to fix the trade imbalances, it's Canada, it's Mexico, it's China. Those are the three currencies. It's not the euro, it's not the pound, it's not the Swiss franc, or even the Japanese yen to some extent. And so that's why it's not a coincidence that the first salvo in the tariff war went to Canada and to Mexico. Because if you want to deal with it, you have to deal with it with those two countries.
So when it comes to the tariffs that the president has earmarked, and they're basically, the agenda is set for March 4th, the pause on Canada, Mexico, do you expect 25% to be added on those imports from those two trading partners?
Yeah, I think that's up in the air. I mean, we're talking about a president who wrote The Art of the Deal, and he's using tariffs for both leverage to get something and potentially revenue or reorient the trading system. So we'll see when we get to, somewhere about midnight on March 4th, whether or not those tariffs actually happen. It's up in the air. But nevertheless, even if they don't, or there's another extension of them, they're going to stick around, the idea of them, for the next 4 years as a leverage point, and if not, as some kind of a revenue point, if some version or some percentage of tariffs are put on those two countries.
Hey, Jim, your thoughts getting a lot of attention over the past week or so. Appreciate the update. Jim Bianco there of Bianco Research. We're getting an update at 6:54 Eastern Time on February 26th from the President of the United States. The Wall Street Journal came out with an op-ed in the past day or so. Trump's tariffs will punish Michigan. This is the response from the president. They are so wrong. In fact, it's just the opposite. The tariffs will drive massive amounts of auto manufacturing to Michigan, a state which I just easily won in the presidential election. They have already stopped numerous new auto plants from being built in other countries. A gigantic win already for Michigan and the United States as a whole. Just let it all happen and watch. It won't be even close.
Sounds like he meant what he said the other day to our Jordan Fabian that asked, are those tariffs definitely going to come to fruition? When you look at the Wall Street Journal editorial board, what they put out, they even quoted the Ford Motor CEO, Jim Farley, which this last month was talking about how this would blow a hole in the U.S. auto industry. The concern is how much higher a cost for these parts to be. And when you look at one single car, how many times potentially on average does it go across the northern border? 6 to 8 times. They're saying this can add a lot more cost to a single automobile.
To Jim's point, they're trying to rearrange trade in a pretty massive way. And to the degree that people are pricing that in, it's unclear.
There's a lot of proposals and a lot of action we might see in the next month or so. Up next on the programme, we'll catch up with Peter Tchir of Academy Securities, Monica Guerra of Morgan Stanley, Ted Maloney of MFS Investment Management, and Andreas Utermann of Vontobel from New York City. The second hour of Bloomberg Surveillance up next.
A year from now, that I think the structure of the economy is going to be healthier, but the path from here to there is going to be extremely messy.
The economy is overheating. We are leaning more and more towards a higher possibility of a hike than an ease.
Ultimately, for now, the Fed is going to stay on hold.
The underlying economy continues to do well. The challenge is 6 months out.
If everyone is expecting things to be fine and then they're not, that could create a negative feedback loop with the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now. Let's begin with your scores. Equity futures positive here by 0.4%, bouncing back from a 4-day slide on the S&P 500. On the Nasdaq 100, up by 0.66%. The main event for the Nasdaq and for this equity market worldwide, taking place later on this afternoon after the close, earnings from Nvidia. Before we get there, you'll get more executive orders from the President of the United States, who moments ago said this on auto tariffs. Lisa, just let it all happen.
And this comes after he said the 25% tariffs on Canada and Mexico are still going to go through. He's talking about how the Wall Street Journal editorial board got it completely wrong, that it won't take jobs away from Michigan, but it will actually increase jobs to some of the auto manufacturing sectors, which speaks to the idea that the ultimate goal for some of this is to really bring manufacturing back to the United States, and he feels like that is being overlooked.
So let's go back to the calendar. Next week, 25% tariffs on Canada and Mexico. The following week, a 25% tariff on steel and aluminum. Then after that into April, 25% tariffs on autos, chips, pharma, reciprocal tariffs, front and center.
That's on April 2nd. And the problem that Trump might have is the fact that this means consumers, as we've seen from the Consumer Conference Board, and we had an individual from that survey on talking about the fact that it's not just Democrats and independents that are saying, I'm a bit concerned about inflation, references to prices in general. Because of this uncertainty out of Washington, D.C., it's also Republicans that might be starting to hit the pause button when it comes to going out and spending.
Part of the problem is, if this were to bring back jobs, I'm wondering if it has to happen quickly before people get a negative sentiment about some of the higher costs. The sequencing matters in terms of people allowing this to continue while continuing to fuel the economy. And that, I think, is what people increasingly are trying to grapple with.
It takes time to trigger a supply-side response. It can take 5 minutes to finish demand. You can do that overnight if you want to. So to have this great realignment of the economy, I think there are some genuine goals here that could increase the dynamism of the US economy, without a doubt. We can talk more about it throughout the program. But there is a price to pay. It's just, are they willing to pay that price? And at the moment, you're seeing that in softer consumer sentiment. Stocks have pulled back a little bit as well. But Mike Wilson of Morgan Stanley said something yesterday that's got my attention, and I thought about it this morning too. I've barely heard this administration talk about the stock market. What happened to the Trump put in stocks? You've barely heard a whisper from them.
You know what you've heard a lot about? That 10-year Treasury yield, which has been basically the driving feature. And Scott Bessent was talking extensively about that 10-year yield. Right now, how much is the uncertainty, as Annmarie has mentioned, a feature, not a bug, in the sense that it actually dampened some of the potential inflationary fears enough to create a calm in the bond market that might not be there if there was more pro-growth types of measures.
And then you deliver monster tax cuts at the end of the year.
Maybe.
That's the genius behind all of
Christmas.
this. 10-year yields this morning, just a little bit higher after declining for 5 consecutive sessions. Equities positive by 0.4%. Coming up on this program, we'll catch up with Peter Tchir of Academy Securities as investors await results from Nvidia. Monica Guerra of Morgan Stanley as President Donald Trump strikes a deal with Ukraine. And Andreas Utermann of Vontobel on global risk to trade. We begin this hour with stocks looking to snap a 4-day losing streak with Nvidia earnings on deck this afternoon. Peter Tchir of Academy Securities writing this: we've been very concerned about the Nasdaq 100. A pullback to pre-election levels would be close to 10% from here, and given what we're seeing in the economy and economic policy so far, that is now my target. Peter joins us now for more. Peter, good morning.
Hey, good morning.
Crypto, absent in that quote, but I know it's important to you right now. Why?
So almost shameful to admit, but I've been watching crypto as a tell much of this year. One, it's a pure policy play on Trump, right? He kind of promised a lot to crypto, so as you've seen that go up and down. The other thing is, I think crypto is now much more tied or linked to the U.S. stock market. And we can talk about correlation, but really this is more of tying in a linkage. And one, on the retail side, you've seen the ETFs go to $110 billion, something like that, right? Up from about $20 billion. So those used to sit either in cold wallets, you had actual Bitcoin, or maybe you were in Coinbase. They're now sitting somewhere in your Fidelity or Schwab, whatever account. And I think people now react to that. It's very hard to separate your crypto investment from your stock investment when it's all commingled. And then you have MSTR, which has really become huge in the last few months, right? It's clearly a crypto-linked stock. You've got MSTX, which is a single leverage, a double leverage ETF on MSTR, which I don't understand why they exist, but it's in the NASDAQ 100. It's only 0.4% in the NASDAQ 100, so it's around the 50th biggest holding, but you now have a direct tie to stocks. And I think that is why you've got to really pay attention to what's going on there beyond the wealth effect.
Does that shape retail flows or institutional flows as well?
I think it starts shaping all flows, right? I mean, you start looking, how many people are chartists, right? So you look at QQQ charts. Well, MSTR is now in QQQ, so whatever's going on in MSTR, it's still a small fraction, but it starts to move it. So I think it moves everything all at once now, much more than it used to.
So it's a broader sentiment gauge at a time where sentiment is clearly rolled over, and there's now suddenly this fear of a growth shock more than some sort of inflationary surge. How much do you lead into this? Because you were saying you could see another 10% downside in big tech. That could be a valuation play, or that could be something more fundamental. Which is it?
I think to me it's probably more of a valuation play. One, again, we are so dependent on these, large index stock flows. Everything kind of, if you start seeing outflows from that, it's going to hit those big, Mag 7, because that's what dominates that. The other part is really what's driving my thinking is we're getting all these headlines, tariffs this, tariffs that. I'm still undecided and have not determined whether we're going to get a great outcome or a bad outcome. I think they're both in play. I think there's a possibility for these really positive outcomes, but I think there's going to be a lot of noise between now and then, right? It's very unclear where we're headed. I think, you now also have the government laying off people potentially. I really don't think the private sector is hiring that much. I look at the quits rate as an important segment. So if all of a sudden you get these job losses, they're not getting picked up in the private sector, I think you get more bad than good in the near term. And it's still, to me, too unclear whether these policies turn out to work out great for the U.S. economy or they're actually detrimental.
Which brings the Fed into play. And it raises a question about whether they're the ultimate lever with plenty of dry powder to support the economy, given that they have rates at 4.5%. Why not just cut rates in response to this? Are they really that hampered by fears of tariffs and inflation? If the data continues to deteriorate, they won't cut?
So I'm still at 2 cuts this year, but I'm starting to lean towards 3 to 4 cuts. I think the data's coming in weak enough. But again, I don't know that that's enough for the stock markets, right? All of a sudden, again, traditionally, and just everyone was so excited when we cut in August, right? Whoa, yields are going down. Yields skyrocketed, right? So whatever the Fed intends, I think this time cutting rates will be a clear signal to the market. Things are not working. And the only reason they'd be cutting, I think, is deglobalization would be accelerating. And I don't see how that's good for the U.S. stock market.
3 to 4 cuts? When do they start?
I think in the May meeting. They're not going to cut at the next meeting. I think that's too early. But as the data starts coming in, particularly if I'm correct, and you do start seeing a weakening in the data, they probably go as early as, not next meeting, but the one after that.
And part of this could potentially be what's happening in terms of the policy uncertainty. You talk about tariffs. Do you think Trump is going to put them all in place, the ones that he has on his diary, starting next week?
I don't think so. I think he, delays, he puts them off. But having said that, it's already impacting people, right? If you're a business, you are very unclear where this is going. You're not about to hire right now. So again, that's why you're getting people laid off. I think when you look at the quits rate, it's already telling you it's hard to get a job. And now if corporations are saying, whoa, we're not sure where this is all headed, what do we do? And also you're starting to see kind of the first signs that maybe the AI build out was a little bit too much. And I've been treating the AI, build out a lot like fiber back in the late 90s, early 2000s. All these companies did phenomenally well. It was a disaster when everyone realized it was overbuilt. Then it all got sucked up and the companies did well again. And I feel like we're at the stage like looking around. Are there too many data centers? Is AI too prevalent? What are we getting out of this? So I see that as being a slowdown. So all those things to me work against the stock market right now, even if the Fed's going to be more aggressive.
So name them. Who's Cisco?
That I do not know. It's So, I think right now the nice part is you can pick a lot of that up just in the NASDAQ 100 since it's so top heavy weighted.
Nvidia's later. I'm trying to work out the winners and losers. Do we have to rethink that after DeepSeek?
I think it's not just DeepSeek. It's now, you've got Grok, you've got everywhere you turn, and it feels like just as you're learning, whatever, ChatGPT 2.0, ChatGPT 3.0 is out, and then there's the O3. The model proliferation is huge. You're kind of using different ones. I think right now everyone's, okay, I'll test this, I'll use that. It's unclear where this all heads. You're seeing more and more of the hallucinations, so it's hard to figure out when you do this, what do you actually use it for? How much do you trust it? So it's all interesting, but I feel the hype got ahead of itself, and we're potentially at the consolidation. The earnings tonight will be very important. My sense is, though, such good earnings are already still built in, even as that stock has declined a little bit, that it's going to be hard for this to really turn the market around. I think sentiment has shifted, and we might get an update or two, and I'm watching cryptos. That starts sliding today. I'm more comfortable that we get that pullback to the pre-Trump election.
Microsoft and Alphabet. That would be the answer I would give you to your question. And they're both down about 8% since the December 17th high because they are the main spenders on a lot of this. And there's a real question about whether they've spent too much and whether they're able to supply the deliverables to a lot of their companies. So I think at this point, that really is going to be the tell in response to maybe to NVIDIA.
Hey,
Just
Pete,
makes sense.
it's good to see you, as always.
And I do like AI. I just feel like
Don't worry, we're not running away with the wrong idea. Pete Tchir of Academy Securities. Pete, appreciate it. Thank you, sir. Let's get you an update on stories elsewhere this morning. Let's cross over to Danny Berger for more with your Bloomberg Brief. Hey, Danny.
Hey, John. President Donald Trump signed an executive action for the Commerce Department to explore a levy on copper. Senior administration officials say it's a national security issue that dumping and overcapacity have left U.S. weapon systems and other critical product dependent on foreign copper. Officials say it's too soon to discuss a potential rate for the tariffs. More than 1 million federal workers replied to the Elon Musk's DOGE-led directive that asks for bullet points to justify their positions and productivity or be fired. That is less than half of the roughly 2.4 million civilian federal workers. The White House press secretary said agency heads would determine, quote, best practices regarding the responses to the messages. Apple investors have rejected an outside shareholder proposal to end the iPhone maker's diversity, inclusion, and equity efforts. However, CEO Tim Cook says that the company may make some adjustments to its DEI program. Investors also rejected requests for reports related to AI risks, child sex abuse materials, and charitable giving practices. That's your Bloomberg Brief. John.
Danny, thanks. Appreciate it. More from Danny in about 30 minutes' time. I'm next on the program, striking a deal with Ukraine.
I will just reiterate his position. It's critical that this deal is signed. He expects President Zelensky to sign a deal. This is to recoup American tax dollars that have been funding Ukraine's national defense.
We'll get the latest on that front. We'll be joined by Monica Guerra of Morgan Stanley in just a moment. Live from New York City this morning. Good morning. Equity futures on the S&P 500 positive here, bouncing back from 4 days of losses. We'll see if this sticks coming into the close. Coming out the other side, earnings from Nvidia later on this evening. This from the president already this morning on auto tariffs. Just let it all happen. The president in the last few days saying tariffs are going forward on time, on schedule.
And tariffs on Mexico and Canada that were expected to come out. A real question here about how much Donald Trump can sell the idea that all of these tariffs will shift jobs back to the U.S. and boost the economy at a time where there are a lot of questions.
We've got to turn to foreign policy as well. Under surveillance this morning, striking a deal with Ukraine.
I will just reiterate his position. It's critical that this deal is signed. He expects President Zelensky to sign a deal. This is to recoup American tax dollars that have been funding Ukraine's national defense. And it's also great for the Ukrainian people who have been put through hell because of this war. And it will create a lasting economic partnership as Ukraine will need to rebuild their country because of this brutal war.
So here's the latest. Ukraine agreeing to the terms of a major minerals deal with the United States. According to people familiar with the matter, President Zelensky will visit the White House on Friday to sign the agreement. Our team coverage starts right now with Bloomberg's Tyler Kendall on Capitol Hill alongside Ollie Crook in Berlin. Oliver, let's talk about this. What changed for President Zelensky?
Yeah, listen, I think that the reality has been dawning that basically a deal needs to be signed. Trump is not going to move on it. But I think part of what changed is the sort of details of this agreement are sort of seem to be left fairly ambiguous in terms of what they entail. So something that might be broad enough to be considered a win from both sides, from the Ukrainian and the Trump side, while also continuing to get that momentum within this deal. From the European side, this is certainly, I mean, we've talked about this for many months now, right? The wake-up call of Trump. I think that now the Europeans are really finally beginning to wake up. We had a video call this morning among European leaders where Emmanuel Macron basically briefed the other leaders about his conversations with Trump. We're getting another meeting on Sunday, probably in London, by EU leaders. And then that all culminates to the big meeting next week on Thursday, an emergency EU leaders meeting, in order for them to basically come together, have a concrete Ukraine strategy. What does it mean in terms of troop commitments to the post-war area within Ukraine? But again, above all, the main issue, if those are going to have credible security guarantees coming from the Europeans, they need to find the money to pay for it. And that is the sort of nitty-gritty of what they need to figure out over the next 2 weeks.
Tyler, when it comes to a win for the president, they're talking about this durable economic partnership. That's how the Treasury Secretary Scott Bessent has talked about it, stronger economic ties. But domestically, how much is this a win for him to say to the American people, we're getting something back for those billions we sent over?
Well, Annmarie, one of the biggest questions here still is what those security guarantees would look like, and perhaps that could give the president a little bit of wiggle room when it comes to his rhetoric on the issue, considering that we know that is something firm that Zelensky had been looking for. Instead, we've really seen this administration say that those guarantees would be implicit, considering that the U.S. would have a vested economic interest here. And President Trump is pushing this idea that this is critical for the U.S. to get back on its investment. But importantly to note, Zelensky has remained firm that the conditions for this aid negotiated under the last administration do not amount to a debt that needs to be repaid. And when we look at the numbers, Congress, where I am, has so far appropriated $174 billion in security assistance to Ukraine since the 3 years since Russia invaded. So far, $84 billion of that has been dispersed. Those numbers align a little bit more closely with what Zelensky says he has been tracking versus those costs that the White House has been talking about. They often put those numbers a lot higher.
Tyler Oliver with the latest in Berlin and down in Washington, D.C. Thank you. Joining us now to build on the conversation, Monica Guerra of Morgan Stanley. Monica, it's good to see you. Thanks for being with us. Lisa said this earlier on this morning, that this administration seems to be more focused on the bond market than the equity market, and a lot of roads seem to lead to the deficit and spending. What can they do about the deficit?
Not much. What they can do is they can reduce deficit spending. I want to emphasize that that's different than actually cutting the deficit. Those are two different issues. So as we stand right now today, if you look at just extending tax cuts, current budget as is, you're looking at about $4 trillion added to the deficit. In the deal that they cut last night, they added $4.5 trillion in cuts total. They're looking at $4 trillion in spending cuts, plus raising the deficit, the debt ceiling about $4 trillion. So 4 is the magic number here. But where that lands us is at about a $2 trillion addition to the deficit. So yes, it does reduce the total spending amount. It reduces that total burden, but it doesn't completely offset deficit spending.
Can they get creative? Because the Treasury Secretary at one point was talking about monetizing the asset side of the balance sheet. Can they find other ways?
There could be other ways that they go about this. Absolutely. I think, the External Revenue Service with tariffs, potentially a pass-through. Right? If you're thinking about accounting metrics, et cetera, for ways to account for revenue raisers, yes, there are different ways to get there. Is it on a net basis a true addition? Not necessarily to the U.S. economy, but how does it look for debt and deficit? You can then offset it from an accounting perspective. So for us, when we're thinking about long term, this does matter. The deficit's over $36 trillion. We're looking at over 100% of U.S. GDP. These measures need to be taken. $2 trillion is definitely more palatable than $4 trillion added. And so for us, it's just seeing where can they get those revenue raisers, and can they even knock it down even further over time?
How much do you incorporate DOGE when you're thinking about bringing down the deficit?
DOGE, not very much. I think that it's incredibly important when we're thinking about the broader resizing and restructuring of government. So the way I'm thinking about 2025 is that this is a restructuring and downsizing of government year. It's something that does, in my opinion, need to happen, especially when we're thinking about debt and deficit and that size. It's something that we've done previously. Under the Clinton administration, they found over $200 billion in savings in 1 year. That's what we're talking about right now with this budget bill. So it is palatable by the economy and by the consumer. Where you're going to have risks with DOGE, and specifically, is on the municipal and local level, where there are high concentration of government workers, where local communities could be impacted, but it doesn't necessarily filter into a broader economic downturn.
Do you believe the argument that tax cuts ultimately will be revenue drivers down the road?
They could be. I mean, I think that what they would be supportive more directly of market performance and the economy. So maybe not a revenue driver for the budget. A tax cut is literally a revenue loss. And so I think it's important to sort of separate those issues. That if you're looking at tax cuts, they're going to go into effect in 2026. And that 2026 then, unlike 2025, which is restructuring and downsizing, 2026 is likely to be your year of growth and policy setting, agenda setting for the Trump administration, and really thinking about his legacy long term as the pro-growth president. So I think that tax cuts play a critical role in that, but it's not the only driver of the growth story.
You know, a lot of times when we hear about some of the headlines or the announcements, it feels haphazard. And yet when we talk to policy advisors, it seems like there's a very clear structure of the reordering of global trade and of the U.S. economy and of shrinking the government that isn't chaotic. Which is it?
Chaotic or not chaotic, I think that it's important to acknowledge that it's normal to feel overwhelmed by the amount of executive actions that have come out of the White House. So I think that that's where the chaotic maybe piece comes in, is that we've had over 70 executive orders and over 300 executive actions, depending on how you're counting. And that is a flood of information for folks. So that does feel chaotic. But the plan here is actually pretty clear. He's focused on getting that budget bill through. As we were all talking a little bit earlier here, he is even actively involved in whipping Congress, right, and helping get those results. So this is the number one priority. Then there's going to likely be a pivot on the policy agenda. DOGE actually becomes a little less important once we have a budget. We understand what those cuts are, and then it becomes about what happens with national defense contracting. How do we frame and think about spending in 2026? Because even though we're focused on cutting right now, that doesn't mean we're not going to spend in the future.
They've been pretty consistent on a number of things. We talked about this yesterday. A lot of government at the border, a lot less government inside the borders. They want to treat investors well, and they want to hurt people trying to export to the United States. That's kind of the deal. How this works out over the next several years, I don't know, but they're the goals.
And that's the reason why Donald Trump's comment on Truth this morning was actually telling, focusing on bringing manufacturing back, which he thinks is a piece that keeps getting lost as people talk about some of these negotiations.
Monica, we keep going back to the calendar. We're doing a survey, trying to work out what people think will and will not happen. Of the tariff proposals on deck right now for the next 6 weeks or so, what do you think actually goes on?
I think you have to take Mexico and Canada seriously. In our assessment, we found that if we do actually levy those tariffs, it could hit the economy over the long run by about 1%. But again, there's an opportunity to renegotiate with USMCA. So I think that you have to consider the longer run play here. So even if it does go into effect, which again, I don't have a crystal ball, but if it does, there's still an opportunity to revisit and rewrite the economy around that issue. So I'm not as concerned about Mexico and Canada because of the USMCA negotiations. I think that's a piece that people aren't talking about. Now, China, other countries, industry and sector specific, I think those are serious. And so we have to see exactly what comes out on April 2nd when we get the full reassessment of reciprocal tariff issues, et cetera, and we'll go from there.
I think that speaks to what a lot of people think right now. When it comes to reciprocal tariffs, you'll see something happen with Europe specifically, maybe more on China. When it comes to steel and aluminum, again, something's going to happen on that front too. When it comes to Canada and Mexico, there's just a huge amount of doubt that they go that far.
Because people are realizing it would torpedo certain industries, in particular the car companies. And that's the reason why maybe General Motors this morning had the conviction, the confidence to go do a whole host of share buybacks and dividend increases, because they're saying this can't feasibly go through. At the same time, as Monica just said, you got to take him seriously because he has followed through on a lot of what he's promised. So, let's see.
We're less than a week out when it comes to Canada and Mexico. And what do we see? Bloomberg reporting that there's talks with Mexican officials about putting tariffs on Chinese imports into Mexico, bringing those tariffs up. Also, front page of the FT today, Peter Navarro internally trying to get the Trump administration to make sure Canada is no longer part of the Five Eyes, the intelligence services amongst all of these groups of nations. How much is that, in right now, a negotiating tactic?
Hey, Monica, it's good to see you. Thanks for catching up with us. Thank you.
Thanks for having me.
Monica Guerra there of Morgan Stanley. Lisa mentioned General Motors approving a $6 billion share buyback. The stock in the pre-market higher by a little more than 4%. Up next on the program, Ted Maloney of MFS Investment Management on opportunities outside of big tech. The big one coming a little bit later, NVIDIA, after the close. Four-day slide on the S&P 500, the longest daily losing streak for the benchmark in America since the very beginning of this year. Equity futures bouncing back, going into earnings from NVIDIA later. We're positive by 0.5% on the S&P. On the Nasdaq 100, up by 0.7%. With your morning movers this morning, here's Yahara Hackers with more. Hey, Yahara.
Hi, John. We start with Lowe's getting a boost here in the pre-market, up 3.3%, because like Home Depot, it expects sales to finally rise this year, marking a good sign for the consumer because we know they have been putting off those home renovation projects due to high rates and affordability issues. So Lowe's telling us here that they finally may be getting past that. Next up, we have a big mover here in Super Micro Computer. Those shares are up 23%, and that is because the AI server maker finally filed its financial results, which means that it won't be delisted by the NASDAQ. And why did it take so long? Well, it was accused of accounting manipulation last year, and then its auditor resigned 2 months later. So a lot had been weighing on the stock, but not today. And last up, we have GM. Shares are rising here 4%, and that is because just this morning it announced it's raising its quarterly dividend to 15 cents, and it announced a $6 billion buyback program. And the stock is up because obviously this shows that GM is confident in its balance sheet amid an uncertain time for the auto industry. John?
A very uncertain time, that's for sure. Yahara, thanks for that. Thanks for that. On our radar this morning, the United States and Ukraine reach an agreement on a minerals deal. Sources telling us here at Bloomberg, Ukrainian President Volodymyr Zelensky is planning to travel to the United States on Friday to seal the accord. The president alluding to that just yesterday.
Just yesterday, he said, I hear that he's coming on Friday. He's like, if he wants to be here and sign this, that'll be great. This is critical, really, for Trump for the next phase to try to get both Zelensky and Putin at the negotiating table, or even just to have a summit himself with Vladimir Putin. The question is, there are questions. What actually is going to be in this mineral deal? To our colleague Javier Blas in London, how many minerals are there in Ukraine? Are there even these rare earths that this draft was talking about? And thirdly, what does Ukraine get for it? You hear a lot of Ukrainian politicians talk about after the deal is signed, we will get actual military security agreement with the United States or some sort of backing. That remains very unclear.
I just want to know if Volodymyr Zelensky and Donald Trump will be in the same room and shake hands and seem cordial. And if that's the case, whether that actually paves the way for people to be more optimistic about some sort of deal again going forward. I mean, really, it's going to be a messaging in terms of body language as much as anything else.
Do you think Zelensky might want a golden visa?
I think that probably... I don't know. It depends on how this meeting.
That was just to set up the next story. President Donald Trump announcing a so-called gold card program offering residency and a path to citizenship to investors who pay $5 million. Trump saying the program will launch in 2 weeks' time and proceeds should help pay down the deficit. Now, I assume this is different to the EB-5 visa, which is the investment visa readily available for investing in America.
They say this will go directly to the government as opposed to the EB-5 in terms of the investment in America. I'm not clear on the vetting process, and I was looking to try to understand. There were some vague concepts about what kind of vetting would actually happen. But is it basically anyone can pay $5 million? And then who is this targeting? Is it targeting very specific people? And, you know, what are the barriers?
I think they're at that stage of concepts of a plan when they're talking about the vetting process. The new Commerce Secretary, Howard Lutnick, talked about we'll have to go through vetting, of course, to make sure they're wonderful, world-class global citizens. So let's see what names come to mind for that. To your point, Jonathan, though, this is similar to the program that Congress developed already in the 90s. But that program was $1 million investing in a business that created at least a dozen jobs or so. This is basically $5 million, bring down the deficit, or maybe this will go to the U.S. sovereign wealth fund they're trying to create.
So the golden visas are very popular programs around the world. We were talking in the commercial break about Portugal. Very difficult to put a price on these things because they can become very popular. Portugal was around €500,000. And you know the story there, how popular things became. They had to really tighten up the restrictions around that program.
Because it increased the housing prices for locals to such a degree. Just taking a step back, though, you have to wonder, are you trying to lure people in or push them out? What is the goal? Are we trying to get rich people to come to the United States to spend their money? Or is this a matter of skilled labor? Is this a matter of vetting process? I'm just looking for some sort of overarching concept of a plan in terms of the ultimate goal.
It's a president who made his money and business in real estate. He thinks transactionally in real estate deals, and money talks.
Let's turn to this story. Bank of America rolling back workplace representation targets and replacing references to diversity. A person familiar with the matter telling Bloomberg the bank will no longer have, quote, aspirational goals for diversity and inclusion. It's those words where they get themselves into legal trouble, not Bank of America, but for most people in corporate America. They want to avoid quotas. And when you go through the communication we had from Bank of America just yesterday, they stress the word opportunity. We want to go back to equality of opportunity, not equality of outcome. And that seems to be the shift of the past few months.
If you talk to a number of executives, they say the ultimate goal of increasing diversity is there. It's just how you go about doing it in terms of having opportunities for everyone and not necessarily having certain training programs that try to get people to speak in a certain way. And I think that that's sort of the shift rather than some sort of wholesale change away from some of the goals of these programs.
These banks and many people working there have been drowning in bureaucracy now for the last 4 or 5 years. We heard one rant in the past week from one big bank on Wall Street about the amount of committees that some people had to attend. They weren't focused on their core job. We're returning to core competency. We're getting away from going to committees, getting away from going to meetings and attempting to get away from drowning in bureaucracy. And I think for a lot of these companies, you can see what's happening to them. Slashing corporate jobs at Southwest, slashing corporate jobs at Starbucks. It's a return to core competency across several dimensions.
Yeah, training companies, training classes don't really fit into that. At a certain point, you wonder how much this is being used as an excuse to do what a lot of corporate executives have been wanting to do, and how much is this trying to really adhere to some sort of vibe shift at the top of the country.
A huge shift, that's for sure. Let's turn to our top story on Wall Street. Investors are waiting results from Nvidia after the closing bout. Ted Maloney, the CEO of MFS Investment Management, seeing high-quality companies outside of tech and writing the following. Market concentration is the most important theme in today's market. History has shown prolonged periods of concentration are followed by equally long diversification cycles. Opportunities can often be found in recent laggards. Ted joins us in the studio for more. Ted, it's good to see you.
Great to be here. Thank you.
Are we moving out from a prolonged period of concentration towards right now beginning a long period of diversification?
Well, by its nature, it's almost impossible to think about specific timing around that. So I might have been wrong. I would have been wrong a year or two ago in thinking that the concentration was already at dangerous levels and due to unwind. So while we're not sure if the last couple of months have been the beginning of an unwind, we are reasonably sure that the level of concentration is dangerous. And I want to point out that's not disparaging comment about any of the companies that make up the concentration. They're wonderful companies, in some cases with reasonable valuations under certain assumptions. But when you put them together, the level of concentration, and you look back in history at times when we've been even remotely close to this, it's ended badly for investors who were over-concentrated in those spaces.
When the stock goes up and to the right on the chart, a lot of people don't think it's dangerous. Talk to me about what's dangerous about it. And when you think about diversification, what does that actually mean in practice?
Well, what's dangerous about it is if one thing goes wrong for one of those companies, and because they're so interconnected, it would be likely to be a chain reaction across the companies, and not just the companies, but the equities that are incredibly highly valued. So diversification is, famously one of the free lunches in investing, and it's interesting. You have moments in time over history where people forget that because, as you say, they get enamored by up and to the right, and it's been really easy to make money in these 7 stocks for the last couple of years. So I'm going to keep doing it. It's very hard to predict what will unwind it. It is a reasonably high confidence bet that it will unwind at some point.
Yeah, there's been the sense that you actually are punished if you aren't necessarily heavily weighted in them because they've been the outperformers. I'm wondering how you position around that, whether you expect the unwind to be somewhat violent as it was, say, in the 2000 period of time, or whether it could just be what we've seen over the past couple of months, which is, a correction. It's kind of happened, but the rest of the market's done fine.
Right, exactly. I mean, I think you approach it from 2 different angles. One, bottoms up, the idea of finding a number of other stocks and bonds that you can buy to balance out your portfolio and make sure that you've got good conviction and long-term returns in there. And then top down, thinking about risk management. Again, our portfolios that have the Mag 7 in their benchmarks tend to own a decent amount of Mag 7. We're not negative necessarily on the individual stocks or the space. What we're concerned about is a risk management question. And managing risk at a portfolio level and looking at a small number of stocks driving all of the returns and most of the risk in a portfolio, we just think is dangerous.
It's notable that since December 17th, you can see that correction in the Mag 7, even though the S&P equal weight is actually up on the period. So a lot of people are doing the same. You made another point that I thought was really interesting, which is that liquidity ideas can really shift at a time where everyone's talking about private markets as being, the bastion of hope and returns. You challenge that. You actually think that in public markets, there potentially is more opportunity. Why?
Well, we just have this quaint notion that over time liquidity is a feature, not a bug. And you have moments in time where all the money will chase illiquids because of an appearance of higher returns or a value proposition that looks really compelling until people want to get their money. And we think it also depends on who the investor is, right? So large, very sophisticated institutional investors with large pools of assets should have a meaningful part of their portfolio in privates and alternatives. As it starts to become mass market, we worry about what that means for a mass market investor who might need access to his or her liquidity and might discover at the worst possible time that they don't have it.
We talked a lot about the United States and diversifying within the United States across various asset classes. Can you walk us through how you think about things internationally at a time where Europe has really started to outperform to start the year?
Yeah, we've always thought that having a global lens is the best way to invest, even if you're just focused on a given region, but certainly if you have the opportunity to invest across the world. We think that U.S. exceptionalism, at this point, regardless of whether or not you believe that it's durable or not, it's priced in. So if you look around the world, you're paying a lot for the U.S. exceptionalism bet to work out. You're paying significantly less in various pockets around the world. And that's across asset class. That's stocks, that's bonds, that's beyond that. So we think there are lots of opportunities outside the U.S., plenty of opportunities inside the U.S. as well. And it's probably never been a better time to be a skilled manager thinking about risk at a portfolio level and being able to make those trade-offs around the world.
Ted, this was smart. It's good to catch up with you.
Appreciate it.
Thank you, sir. Ted Maloney there of MFS Investment Management. Speaking of what's happening here in the United States, lots of retail earnings coming through over the past few weeks. We heard from Walmart, gave a little bit of a softer than expected outlook. Similar thing came from Home Depot just yesterday. Heard from Lowe's already this morning and TJX, Lisa, just moments ago.
Yeah, and you can see that the shares are responding not to the fact that they performed better than expected in the fourth quarter with sales beating expectations, but their forecast for fourth quarter sales actually came in below expectations. So again, it is the forecast that is really the issue. Right now, stocks have turned around. They initially were negative. Question that I have is in the calls. How much conviction do they have in terms of where consumers are going to be going given the uncertainty we've seen?
Question I've got for a lot of the retailers beyond TJX, I'm thinking more of Target. How do you manage inventory in a moment like this? A lot of these companies had to diversify away from China 8 years ago. I imagine they've done a lot more work than that to really improve their supply chains, particularly coming through the pandemic. But we saw what happened with Target going into the end of the year. Hit a massive inventory landmine all over again. You're going to see that somewhere. I don't know who is going to be the one that steps on that landmine, but ultimately you will see it at some point.
And it probably is more significant in the retailing segment, not necessarily the grocery segment. So I wonder how many of these are going to start leaning in to areas that might be somewhat immune to those threats.
TJX with their outlook seeing the first quarter sales +2% to +3%, the estimate +3.27%. So just a slight miss on that outlook there for the first quarter. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Dan.
Hey, John. Hamas says that it has reached an agreement to free Palestinian prisoners from Israel. The group had refused to continue talks for a second phase of the ceasefire until they were freed. Meanwhile, Israel suggests that it wants to extend the Gaza ceasefire when it expires on Sunday. But Israel's foreign minister told his European counterparts that an extension will not happen until more hostages are freed. DeepSeek reopened access to its core programming interface after a 3-week suspension. The Chinese AI company says that it's again allowing users to top up credits for use. DeepSeek suspended the service earlier this month due to capacity shortages. In a sign of rising AI competition in China, Alibaba has also previewed its own model. The White House says that it's taking control of picking and choosing the group of reporters able to cover President Donald Trump in places including the Oval Office and Air Force One. The decision came a day after a federal court declined a request by the Associated Press for a temporary restraining order to halt White House efforts to block them from the press pool. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Donald Trump's favorite word.
The guy ran on tariff being his favorite word in the dictionary, and now you're surprised that he wants to go through with it? I mean, it's crazy.
Andreas Utermann of Vontobel joins us next from New York City this morning. Good morning to you all. You're watching Bloomberg TV. The main event a little bit later on this afternoon after the closing bell. Earnings from Nvidia, the stock in the pre-market positive. Bouncing back from recent losses, we're higher by 2.6%. The broader equity market on the S&P 500 bouncing back from a 4-day slide. The longest losing streak since the very beginning of this year. Equity futures higher by 0.5%. And the move we've seen on a 10-year yield over the previous 5 days, a 5-day move of 25 basis points lower on a 10-year, a break of 430 this morning, 429.44. Under surveillance this morning is President Donald Trump's favorite word.
I do find it kind of amusing how everyone is basically using tariffs and policy uncertainty as a rationale for their forecast adjustments now. I mean, to me, it's a bit rich, as if, if you thought that, I mean, why didn't you make your changes back in November after the election? It's not, I mean, the guy ran on tariff being his favorite word in the dictionary, and now you're surprised that he wants to go through with it? I mean, it's crazy.
So here's the latest this morning. President Donald Trump signing an executive order directing the Commerce Department to examine possible copper tariffs. New levies on steel and aluminum are set to begin next month. Andreas Utermann of Vontobel writing, while these tensions create short-term disruptions, they also reinforce the importance of being able to move swiftly and allocate capital where risk-adjusted returns remain attractive. Andreas joins us now for more. Andreas, welcome to New York. It's good to see you.
Hey, good to see you too.
Thanks for being here. Let's start with the tariff story and whether we've seen any of those dislocations yet as you look across markets around the world, dislocations that you'd like to take advantage of.
I think we've seen lots of dislocations. I'm invested in some startups, for example, and 2 of them have gone bust, the direct result of some of the executive orders that have been signed by the president. So it's very interesting. The world is changing.
There's been more than 70 executive orders. Which executive orders?
U.S. aid. So I had one that was involved in water sanitation in the Philippines, and they had been told they were going to get this money, and they run out of money. And the other one is a company that was actually featured in some Marvel movies with their coffee machines, and they were being produced in China. And with the tariffs, that's it.
So what potential opportunities, though, do you think these tariff headlines, the executive orders, the executive actions could lead to if, on the other end, you're dealing with busts? Where are the opportunities?
Well, I think it's very, very difficult to predict where this is all going, because there's so much going on that it's impossible to keep track of it. Also, whatever announcement is being made could, within 24 hours, be rescinded and changed. So I think it'd be wrong right now in this tsunami of announcements to try to make predictions and then change your strategy accordingly. I think what's really, really important, and that's what we're advising our clients to do, is to be maximally diversified. Because that's the only way you're going to. If you take a bet and you're wrong, you lose a lot of money, so diversification is the name of the game. By the way, I mean, I don't need to remind you of this, it's the only free lunch in town, right?
Well, that's what we just were hearing. And the question that a lot of people are saying, we were just hearing the exact same argument. And the key question, I mean, but it's an important one. Maybe it's true. The question really is, what is diversification? How do you diversify at a time where you have polar opposite risks of whether inflation picking back up or inflation going down, of tariffs going on, or potentially the end of the Ukraine-Russia war leading to some sort of boom in Europe? What does it mean to you to truly have all of those ballasts?
Absolutely.
In play?
I mean, we're in New York. We had a meeting yesterday, and we had a drinks event at our offices last night. We had a big crowd of people who were interested to hear exactly that. What do we do? How do we diversify? And one of the ways that a U.S. citizen or U.S. person can diversify is ask themselves the question: is the U.S. dollar going to be worth as much as it is today in 5 years' time? If you look back to 1970, against the Swiss franc, the US dollar was 4-1, now it's 1-1. So clearly it's gone down a lot. And so if you're a US person, you might consider putting some of the assets outside the US dollar. Similarly, if the policymakers worldwide are so focused, as they seem to be, on getting the real economy going and getting capital into the ground, that typically would mean that value shares are going to have some sort of recovery, and they're very cheap compared to the Magnificent Seven, for example. Then you might ask yourself, if you're looking at the proportion of the U.S. equities as a proportion of the MSCI world, it's at an all-time high of between 73 and 75%. How sustainable is that? Well, unlikely it's going to be sustainable. So you might diversify away from U.S. equities into emerging markets. I don't know.
Well, I don't know. We can go there. We can go to emerging markets and your investments there. But in general, that's actually what you're seeing in the market this year. You're seeing the Magnificent Seven really underperform, have a correction. You're seeing the equal weight outperform in a dramatic way. You're seeing the dollar weaken. I mean, it's all of these trades. Europe has been outperforming. How far is it? Right? I mean, has it gone far enough where people are putting their chips on the table, or do you think that those trends are here to stay for the remainder of the year?
Well, I mean, trends typically are multi-year in markets. And so if this is indeed the beginning of this trend, which remains to be seen, we could have another 2 or 3 years of what we've seen in the last 10, then that would be interesting. But the question is not so much the timing of getting the trend right. It's once you think a past trend or an existing trend is coming to an end, is getting a bit long in the tooth, then you need to act and make a change, notwithstanding what might happen in the next 6 to 12 months. So if you're concerned today, act. You might be wrong for 6, 12, 18 months, but ultimately over the longer period, you'll be right.
Let's talk about the bond market as well. There were some concerns coming into the year about whether fixed income would be a source of risk, specifically treasury markets. Then all of a sudden, the past 6 weeks or so, yields have just dropped aggressively, 6 consecutive weeks. I talked about the last 5 days, a 25 basis point move. Are bonds going to be a source of risk, or will they provide that risk mitigation that people typically go to bonds for?
Well, I mean, bonds, particularly treasuries, but also, as we've seen, UK gilts can be a source of risk if policy action is deemed by the markets to be inappropriate. Now, since we don't know exactly where policy is going to end up, difficult to say, but that's always going to be a source of risk. But beyond that, I do believe that inflation is relatively under control, meaning it's not going to go back to 4 to 5 or 6%. If that's the case, then interest rates pretty much in every major bond market are about the right level. And if you're invested in bonds, you'll get the benefit of a roll down. So you'll actually make some good returns. And on a risk-adjusted basis, might look quite good. So I'm bullish on fixed income.
This raises a question about credit, because credit has gotten a little bit ahead of its skis as everyone's been searching for income. Yeah. Do you see government debt as actually the best bet here, given how far credit has already rallied around the world and the fact that potentially there could be more wobbles going forward?
Yeah, look, I'm the chairman and not the fixed income specialist. But if you're asking me personally, I would agree. I think that government debt in many markets is relatively good value. Now, particularly TIPS, I mean, if you look at the real yield on TIPS in the US, it's 2%. If you're worried a little bit about inflation, that's a good real return. Lock it in.
Just used to asking you about fixed income. Known you too long. Andreas, appreciate your time. Enjoy your time in New York as well. Thanks for being here. Andreas Utermann there at Vontobel on the diversification effort coming into a new year.
I love it. He's basically saying, look, someone below me does that. I don't do that anymore. But, I'll humor you. I love it.
Well, speaking of the 10-year yields, yesterday Scott Bessent was talking about Trump's policies to naturally drop. Trump's policies should make 10-year yields naturally drop. So it's a feature, not a bug.
At the moment, it's the weak data driving those lower yields, particularly in Friday's session and in yesterday's session as well. Up next on the programme, we'll catch up with Stephen Auth of Federated Hermes. We'll speak to Chris Caso of Wolfe Research, Lydia Boussour of EY and Meghan Robson of BNP Paribas. The third hour of Bloomberg Surveillance is just around the corner. With equity futures right now on the S&P 500 positive by 0.4%, bouncing back from 4 consecutive days of losses on the benchmark in America. Nvidia in the pre-market, that's going to be the big one later. Nvidia in early trading is positive by 2.4%. The big one reports earnings after the close. From New York, this is Bloomberg.
A lot of the reasons why Germany and Europe is rallying, and even China, was because the Mag 7 is really underperformed.
It's earnings that's really going to drive the market this year. We think the market's ending around 6,600.
The potential for a growth scare is sadly for real. Hard to see the market moving up 10% from here.
More and more investors would rather own big tech. Obviously, there's regulatory risk, but that continues to be, I think, at the top of the mountain when it comes to AI revolution.
There's still a lot of uncertainty, fear, and doubt for good reason.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
We're 90 minutes away from the opening bell, and here's the state of play. Equity futures positive by 0.5% on the S&P 500. For now, at least, snapping a 4-day losing streak. On the Nasdaq 100, bouncing back, down over that period by around 5%. We're up this morning by 0.7%. Later on this afternoon, a major earnings report, the most important earnings report on the planet. Nvidia coming after the close.
And it actually is even that much more important because you've seen a full correction in the Magnificent Seven in the United States since December 17th, when they reached an all-time high. And what we've heard on this show from guest after guest is the importance of diversification. That is what we have seen. So is that correction just diversification, or is it the beginning of a new trend that Nvidia solidifies by showing that some of the demand in the application is maybe not as exciting as people previously
It's interesting because right now driving this equity market hasn't been big earnings stories from the likes of Nvidia. It's been small data points, things like Mitch, consumer confidence. That's where the jitters are at the moment.
And the jitters are really around whether it's inflation or growth that should be your main concern. And right now it seems like it's growth. And that's the reason why you're seeing yields go lower. At the same time, it's not consistent. Try to get a consistent narrative in this market. Good luck. Please let me know if you find one, because I'm not finding one. The equal weight still outperforming. So it doesn't make sense that this is truly a growth shock as much as people that are taking an opportunity to diversify ahead of a great degree of uncertainty.
Jonathan Krinsky of BTIG has written about this over the past week or so. If you look at the internals of the equity markets, cyclicals versus defensives, discretionary versus staples within equities, that growth fear is slowly coming to the surface. See the same thing in the bond markets, 6 consecutive weeks of declining yields. Talked about the last 5 days. 5 days, a decline of 25 basis points. There is some nervousness out there, some inertia. People are pausing. They're waiting to see what happens with policy. The president couldn't be clearer. He's already said this morning tariffs are going on.
He said just let it all happen when it comes to the auto tariffs, basically a rebuke to the Wall Street Journal's editorial board this morning. But you see this in the survey data, what individuals are saying. They're concerned about inflation, prices going up. We heard it from Lowe's this morning. How many consumers are just waiting on the sideline to get that certainty out of Washington where prices may be going because of tariffs? But what's the uncertainty, to Jonathan's point, when the president said it's happening?
What's it about Canada? What happened with Canada? I don't understand. I'm serious.
I heard from
feel
some
like
Canadians over the weekend who are actually very upset.
I've gotten a lot of hate mail. And I mean, you see the booing, but it goes beyond that. There's a feeling of betrayal. And I guess I'm trying to understand what the end game is also, and whether I should cancel my trip to Montreal.
So I won't get into the feelings. I respect the feelings. I'll get into the policy. 25% tariffs on Canada and Mexico. It's a week away. It is literally just around the corner.
That's on Tuesday. And then coming down the pipeline is 25% on aluminum. Last night we got also a memorandum on how the Commerce Secretary needs to look into copper. April 1st, though, I think is really important because that's when everyone needs to report back to the president. And by the way, we're going to have a cabinet meeting today, so maybe we'll get some preliminary data into what we might find out on April 1st. This is going to be across the board where this administration sees trade practices that are unfair and want reciprocity.
Executive orders coming later on this afternoon as well, so look out for that. Equity futures right now on the S&P positive by 0.4%. Coming up this hour, we'll catch up with Stephen Auth of Federated with stocks bouncing back. Chris Caso of Wolfe Research with a preview of Nvidia earnings, and Lydia Boussour of EY on why she's still constructive on the US consumer. We begin this hour with stocks looking to end a 4-day losing streak ahead of Nvidia earnings after the closing bell. Stephen Auth of Federated Hermes writing, the data is far from conclusive. The intermediate term picture remains so promising that we are unlikely to be steered out of our overweight stocks position, and we haven't changed our 7K year-end target on the S&P. A good friend of this program, Stephen, joins us now for more. Steve, it's good to see you.
Likewise.
I said earlier this morning you've got to skate to where the policy puck will be 12 months out. Where will we be a year from now?
That's what we're trying to keep people focused on. I wrote a piece a few weeks ago called Strapped to the Mast, this idea of, Ulysses trying to navigate the Straits of the Sirens. And no one had ever successfully done it. He figured out how to. He put wax in the ears of all his sailors, tied himself to the mast, and he sailed through. He's the only guy to ever hear the sirens, And I think that's kind of where we are. We're seeing the siren calling to the rocks here on all fronts right now. And we think we're heading into a soft patch. Our take from the earnings season was, the beats were great. NVIDIA tonight, by the way, it's going to be a beat and raise. Everyone knows that. The issue is they're not going to be able to decrease uncertainty about the out years because of DeepSeek. And in general, the takeaway from the earnings season was the CFOs are saying, we really can't give you much guidance here. We have too much policy uncertainty in the near term between we don't know what the regulations are going to be, we don't know the tariffs are going to be, we don't know what the taxes are going to be. So there's a slowdown on the business side happening right now. The consumer is starting to run out of gas. We've seen that. And then you got a kind of systemic job cut going on, not because of a banking system problem, but because of the Dodge tax cuts. But I'm always sensitive to anything that's systemic because it can have a more powerful impact than just the sheer number of it.
Steve Cohen talked about this as well, that maybe Doge's austerity, think of tariffs as a tax hike. I want to understand from your perspective whether you look at the complete policy mix as still pro-risk, pro-growth. Because at the moment, I think we're only focused on maybe one or two dimensions of a much, much bigger policy mix from this administration. Is it still pro-risk, pro-growth?
It's pro-growth, right? And that's sort of the thing we're strapped to here. So we've got near term, we're heading into a soft patch. But on the other hand, intermediate term, even within 3 months, a lot of these uncertainties are going to be lifted. We'll pretty much know the tariff thing. The tax thing will be further along. A lot of the Dodge activity will be over. And, there will be a burst of enthusiasm, we think, on all those fronts and get us through to higher earnings by the end of the year and next year even higher still. So, we're at $300 in earnings in 26. We think we'll go to $350 in 27. We got economic growth accelerating. So we're coming into a soft patch here. We're barbelled. We have overweight stocks, mostly the everything else trade. We're overweight cash. We've got an emerging markets play on here. Those are very undervalued markets. We think, we've talked about in the break, how Trump goes global here, right? He's having a very powerful effect in Europe and even in Asia of people either imitating him in terms of deregulation and tax cuts, which is something Europe, talk about a dry desert that could use just anything.
Well, hold on a second. All right.
The stocks are cheap.
Okay, we can talk about the desert in a second, but I am wondering about the pro-growth impulse and where it's exactly going to come from later this year. It depends, right? Is it going to be from tax cuts? Is it going to be from more efficiency? Is it going to be from the deals that people said we're going to get done this year and that have been put on hold?
All of the above. You just made the whole list out there, Lisa, right?
What did I forget?
Yeah, and that's the power of the thing. The whole program is pretty powerful, and he does seem very determined to get it implemented. You had Scott Bessett on your show earlier this week. He's a very serious guy, and they're marching forward on all these fronts in an alarmingly, for some people, fast way. But we get 3, 4, 5 months out here, this is going to be a lot clearer, and it looks to us like most of it's going to come through.
Why do you think it's going to be clearer? When it comes to China, we're just at the beginning stages, as far as I understand.
Well, we'll get past April, at least, we'll see where that is in terms of Mexico and Canada. And our guess is he tries to solve something there first, I would guess. If I was playing chess, that's where I would try to make sure I got resolved. China, he thinks we have a very unfair deal with China, and my guess is, everyone else sees that too. We're already seeing manufacturing move back towards the U.S., and that's probably likely to continue.
True, that's a bipartisan issue.
Yeah.
You mentioned Europe. How much is Europe stuck between war and peace? Either a trade war that can really hurt them, and potentially a peace deal in Ukraine that can actually help the continent.
Yeah, people are starting to think this peace deal, right?
Well,
let's talk about a peace dividend
Friday.
here. Yeah. There could be a peace dividend in Europe. We're looking at something much larger than the Marshall Plan here. Our estimates are like $500 billion worth of costs to rebuild Ukraine. And, that's going to stimulate a lot of activity in Europe. Where's all that stuff going to come from? Some from the U.S., but a lot from Germany, which has been dead in the water. The Germans are moving towards, after this election, moving towards some form of deregulation and lower taxes. So, yeah, I think a lot of good things could come out of a peace dividend here, especially he's making a rapprochement. I'm not a fan, most of us aren't, of Russia and Putin and all that, but he seems to be trying to make some sort of rapprochement. Did I say that right, John?
I'm not going to correct you. You're anticipating potentially a re-rating of European equities, but also maybe an earnings tailwind as well. They're two different stories. We've seen a re-rating of the multiple. A lot of people have made that argument over the last 10 years. Look at the multiple, look at the valuation gap between the US and Europe. You'd be the first to say there were real reasons for that valuation gap. Do you really see earnings picking up on the continent anytime soon? Do you see good reason for that?
Well, it's a cyclical economy, and it's a financial-driven economy, a lot of banks, a lot of materials. So if there is a peace dividend and you get some deregulation and you let the banks start doing some mergers and cost-cutting, you could see an earnings pickup in Europe. Absolutely. Why not?
We've got to see a cultural shift. That's for sure.
Yeah. I mean, we're not heavy on Europe, but we're there and we're watching to see that. We're more overweight emerging markets where we think they've got more levers to pull more quickly.
What levers
and those
have they got
markets
to pull
are even cheaper.
In EM? What do you like about EM? What are the policy levers they can pull?
Well, China, for one, which is the biggest leader in GM, they've got more money than God, frankly. And they've been holding back to stimulate, I think, because they're kind of waiting to see what Trump does. And that's going to be their counter. So you've got the cheapest market in the world there. You've got a lot of tech companies there. He's also pulling back the press down on the tech sector. You know, Jack Ma has resurrected.
It's quite a statement.
It's a big statement, and that means a lot to people in China. So there's some good things going on there that, you know, probably aren't fully discounted yet.
Some good things going on in your life as well, just to wrap things up. New book coming out. Do you want to promote it?
Got a new book, Visions of the Divine. You can get it on any bookseller near you in 3 weeks.
Any market
certainly
lessons in
pre-order
there?
on Amazon.
Any market wisdom?
Humility at the highs, confidence at the lows.
There we go. Looking forward to getting a copy of it. Steve, appreciate your time.
Yeah,
thank you,
you.
sir. You're a gent. Stephen Auth there at Federated Hermes. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump signed an executive action for the Commerce Department to explore a levy on copper. Senior administration officials say it's a national security issue, that dumping and overcapacity have left U.S. weapon systems and other critical products dependent on foreign copper. The officials say it's too soon to discuss a potential rate for the tariffs. And just out, President Donald Trump has criticized Apple's move to keep DEI policies. Trump posting on Truth Social that the company should get rid of rules, not make adjustments. Apple investors had rejected an outside shareholder proposal to end the iPhone maker's diversity, equity, and inclusion efforts. However, CEO Tim Cook does say that the company may make some adjustments to its DEI program. After 20 seasons, 3 titles, and 6 Olympic gold medals, WNBA superstar Diana Taurasi has officially announced her retirement. The 42-year-old joined the league back in 2004 as the #1 overall draft pick after leading UConn to 3 straight national titles. Taurasi ends her WNBA career as the league's leading scorer with over 10,000 points. John.
Hey, Danny, thank you. Appreciate it. Up next on the program, the Morning Calls Plus. We'll catch up with Chris Caso of Wolfe Research. Looking ahead to NVIDIA earnings next from New York City. This is Bloomberg. The opening bell, 1 hour and 14 minutes away. Equity futures right now just about positive by 0.5%. In the bond market, yields settled down again with sub 430 on 10s, 428.87 later on this afternoon. Some executive orders potentially from the President of the United States, Donald Trump. Then after that, NVIDIA earnings. We'll talk about those numbers in just a moment. Let's get you some morning calls. First up, HSBC upgrading Home Depot to hold, noting the company's positive same-store sales. That stock is up by 1.4%. Your second call from Morgan Stanley upgrading Intuit to overweight following its 2Q results, citing building momentum in small business. That stock is up in the pre-market by more than 8%. And finally, Bernstein upgrading Alibaba to outperform, citing its AI potential. That stock bouncing back by close to 5% in early trading. Let's stick with AI. NVIDIA earnings due later on today. The numbers will be a crucial indicator of where artificial intelligence currently stands. NVIDIA's report comes after the emergence of Chinese startup DeepSeek caused a shake-up in the outlook for AI infrastructure. Chris Caso of Wolfe Research joins us now for more. Chris, welcome back to the program, sir. It's good to get your thoughts as always. Walk me through what you're expecting to see after the close.
Yeah, so for this quarter, we're actually expecting an inline report, inline guidance, which is a little bit departure what we've come to expect from NVIDIA with pretty significant beats and raises. And we came to this view after being in Asia in early December. We got some indication of what's happening with the supply chain, and the reason is they're now ramping their next generation Blackwell systems, and it's pretty complicated. They're moving to full systems. And I think it's going to take a little time for that to go. We don't think it has anything to do with demand. And what makes us feel good about the year, and the reason why we're still positive on the stock, is that you're seeing the very strong CapEx budgets that were announced by most of the cloud providers earlier this year. That money's going to be spent somewhere. We think a lot of it's going to be spent with NVIDIA.
But is demand still insane, Chris? And I know that sounds sort of tongue-in-cheek, but that's sort of what Jensen Huang was talking about, that it's so insane that you can't get enough. Is it the same, or are there some questions that might be reflected in NVIDIA's earnings about just how long the spending can go on without some more significant gains?
Yeah, and they're good questions, right? And that's why the stock reacted, and all their stocks reacted to DeepSeek as they were, because things are growing so fast. Any kind of speed bump along the road is important. But again, what really kind of gets us is those CapEx budgets, and at least what you're seeing over, at least for this year, is there is still a race to be first with the most innovative AI features. And you really need NVIDIA to do that. Over time, and this is not for this year, but beyond, the question is going to be, are you getting enough return on investment on the massive money that you're spending? And that's a good question, an open question. It's frankly not been answered yet. But, that's going to determine CapEx budget 26, 27. But, based on the data right now, people are still spending.
Well, Chris, that's exactly where I wanted to go, the sort of game-changing developments that a lot of people have been looking for in artificial intelligence. ChatGPT is writing homework, it's grading homework. I can look at a Google search and get a lot more results more efficiently. Are you seeing any signs that there have been any game-changing technologies or uses to artificial intelligence that can prolong this in a way that can overwhelm some of the concerns about being more efficient, i.e. DeepSeek?
Yeah, and in many cases, yes. And, some examples, for example, in software, a lot of code is now written by AI as opposed to humans right now. It's been massive productivity gains. In things like drug discovery, you've opened markets that just weren't able to be opened before. And that's why there's another important event coming the third week of March, and NVIDIA's GTC, the developer event. There'll be some investor events around then. We think that a big portion of that event is going to be dedicated to showing people what can be done with AI, what's kind of the next step for driving ROI, because this isn't just an NVIDIA event, it's an overall AI event. And perhaps it helps to answer some of those questions and also to address the concerns that came around DeepSeek.
Chris, what is this company's exposure to China currently?
Well, it's a lot less than what it was. And, as you know, that they're restricted in what they can sell to China to one product, the H20. So it's much smaller than it had been in the past because they can't sell everything to China. And what they can sell, the H20, which is a reduced version of the leading edge chip, the ASPs in that are just lower because of the lower capabilities of that chip. So that's why the revenue is down. One of the concerns is, and this came around DeepSeek as well, are some of those chips coming into China, by a back door? And that's one of the things that's also, kind of one of the concerns in the stock is, if some of these loopholes or such are closed, could that have an effect going forward? But right now, China is not the biggest part. It's a very small part of revenue right now because of those restrictions.
So, Chris, if that headline crossed, and I just want to do a little bit of scenario analysis for people that hold the name, you know the name far better than I ever will. If the headline crossed and this administration did everything it possibly could to make sure that anything that NVIDIA sells does not go to China, what would it do to this name?
Well, the stock would be initially down on that for sure. But here's the point, though. And right now, the H20, the product that they are able to sell in China, was designed specifically to make the capabilities that NVIDIA chip equal to what China could do locally, the Huawei chip, because Huawei can do an AI chip. They just can't do leading edge. So the problem is, if you reduce the capabilities of the H20, or if you tell NVIDIA they can't sell anything into China, well, you're just going to drive all the business to Huawei, and that doesn't advance anyone's interests either. So I think the way the controls have been set up already, which is NVIDIA can ship into China at an equal capability to what China can do on their own, it is the right approach at this point.
How do you view Huawei right now when it comes to where they mark up in their, most high-tech version compared to NVIDIA?
Well, again, it's orders of magnitude less than what NVIDIA can do. And the reason is because of the export controls on semiconductor equipment that goes into China. So Huawei can't use TSMC to produce chips, and the local suppliers in China can't get access to leading-edge manufacturing equipment. So Huawei's semiconductor manufacturing is in some ways just kind of frozen in time on an older node. So they're doing the best to kind of keep up with, but they've got, a lot of restrictions that make it difficult for them to do so. And again, those export control restrictions on semiconductor equipment and manufacturing have been very effective in reducing their capability to keep up.
Hey, Chris, appreciate your time, sir. As always, looking forward to the results later. Chris Caso there of Wolfe Research on NVIDIA. Based on what we've heard from their biggest customers, based on their earnings, they're going to still spend a lot of money in the years to come.
Is it enough to spend a lot of money this year and next year? Or now are investors looking for the longer-term plan of just how long they need to be building out some of the infrastructure for the gains that people have promised in machine learning?
Just wanted to share some headlines with you on Zelensky, getting some comments from the Ukrainian president over in Kyiv on the natural resource deal with the United States. Says he's received an invite from the U.S. administration to visit, that he needs more time to examine the U.S. deal draft, going on to say plans to meet with European leaders in London.
So it sounds like he's going to go on a world tour. And the most important is going to be that meeting in the Oval Office with President Trump. Interesting, he says he needs more time to examine this deal because we have reporting that they've pretty much signed off on this. Potentially the details would be worked out as he's expected to be in Washington, D.C. this week on Friday.
So the administration expected some kind of agreement in Munich. And Secretary Besson had told us last week that essentially they were upset by the way that he behaved in Munich. Again, we're sitting here thinking that this deal was done, and we're hearing from the Ukrainian president again, who's suggesting maybe it's not.
Well, I would say that a lot of this and what you're seeing in the press is negotiations. It seems like they are negotiating via the press when it comes to this agreement and to this deal. And I'm sure following these headlines, we're going to have a Truth Social or today in the cabinet meeting in the early hours this morning when President Trump convenes his cabinet, we're going to hear potentially more about this.
I think it's interesting he's going to London first. It's sort of trying to figure out what the Europeans are willing to give before heading to figure out what his negotiating position is with the United States.
I actually don't know what order he'll go to where. I've actually got no idea. We'll see.
Well, London would make sense, though, because Emmanuel Macron was just here. He's probably talking to him. Maybe he'll get a readout from the individuals around Keir Starmer, unless Keir Starmer can make it back in time. I don't think that's possible. But yeah, unclear on the order. But the most important meeting will certainly be the one in Washington.
Without a doubt. Coming up on this programme, we'll catch up with Lydia Boussour of EY and Meghan Robson of BNP Paribas. From New York City this morning, good morning to you all. Important day, the financial markets worldwide. Earnings from NVIDIA after the close. The open about 60 minutes away. Equity futures bouncing back. Near session highs on the S&P, up by 0.5%. Bigger gain on the Nasdaq, bigger decline over the previous 4 days. The Nasdaq 100 up by 0.8%. With 60 minutes until your cash open, let's get you an update on some morning movers. Here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with TJ Maxx. Those shares are getting a boost here in the pre-market, up 3.4%. It had a solid holiday quarter, but it gave a cautious outlook both in the current quarter and also for this current fiscal year. But shares are up potentially because, like GM, it's going to raise its dividend, and it announced a new share buyback program. Next up, we have Workday. After the shares are up 10% here now after the HR software company beat on both the top and bottom lines. And analysts over at Evercore ISI saying the results reflect what bulls were hoping to see. They point to the solid outlook on subscriptions as well as the tick up in operating margins. And because of this, Evercore ISI says Workday remains one of their top rebound ideas. And last up, we have the popular lunch spot Cava. Those shares are up 3.7%. The company beat on both the top and bottom lines. And analysts over at William Blair saying that the results cap off what was a stellar year for the company. But looking ahead, they did note that the profit guidance was a little shy from what they were expecting. John?
Yahara, thank you. Appreciate the update. Let's turn to the US economy. Investors looking ahead to jobless claims tomorrow morning and PCE data on Friday after consumer confidence fell last month by the most since 2021. Michael McKee, our economics and policy correspondent, joins us now for more. Morning, Mike. What's the next stop for this conversation?
Well, you know, it's kind of interesting, John. There's a discussion underway on Blue Sky this morning, the social media group, about how people will take NVIDIA today. Is it going to be something just about NVIDIA, or is it fit into a vibe about the overall economy kind of being in the doldrums these days? We look at the confidence numbers. Consumer confidence fell by almost 7 points. And as you mentioned, the biggest since 2021. And the expectations index 6 months from now goes below 80. And that's usually a signal, the conference board says, that there's a possibility of recession ahead. How close are we to that? That's going to be kind of the question that we're looking to answer in the data that comes out over the next week. We're getting to the end of January data. Now it's going to be February, which will be reflecting what's happened since Donald Trump came to office. And we'll see next week, obviously, with payrolls. That's going to be a big one. And with ISM, what's manufacturing doing? But before we get there, we get the PCE numbers on Friday. People are going to want to know if people are spending. The forecast is spending dropped back a lot during the month of January. We had some indications from, say, TJX and from Home Depot yesterday that people are still spending. Are they? That's going to be a key factor for the vibe feeling. But then the good news is we're supposed to see a decline in inflation in PCE. And if people start to focus on the Fed and maybe they can cut rates again, then might turn the markets around.
Mike McKee, things are changing quickly. Appreciate the update. Thank you. Can I just say there's no blue sky over on Blue Sky? It's a very dark place when it comes to the economy and the outlook for the United States of America.
I haven't spent a lot of time there.
I haven't
merged over there either.
It's darker than Bramo's outlook for markets. Let's put it that way.
Wait.
Super bearish
Maybe I
stuff.
need to work on that.
Lydia Boussour of EY writes the following. Looking through the noise, the consumer picture still looks fundamentally healthy, though we expect spending momentum will cool further. Lydia joins us now for more. Lydia, welcome to the program. A warm welcome, because we're getting a lot of noise, so to speak. We've had new Mitch. We had the conference board consumer sentiment data yesterday. Confidence, not great. We've seen it in retail sales. We've seen it in several outlooks from several retailers. Lydia, where do you get the signal from?
Yeah, good morning. So yes, we get a lot of noise in the data, and that typically happens at the beginning of the year, looking at the retail sales number, which were quite weak as well. But there are some signs that the consumer is downshifting from that strong momentum that we've seen at the end of last year. We look at the soft data, so the consumer survey data, as an indication of where things are heading. I think it's important to also keep in mind that how consumers are feeling is not necessarily always a gauge of what they are doing and how they're spending. But when we look at the consumer fundamentals, the labor market is cooling. We've seen a slowdown in real disposable income growth, which is really key in terms of spending trends. And that means more moderation in spending ahead. And of course, we have some risk on the horizon. Trade policy uncertainty has risen, and that can lead consumers to really adopt more of a wait-and-see approach.
I keep thinking about what Neil Dutta over at Renaissance Macro is saying, which is this was the trajectory for a while. It didn't have to do as much with tariff fears and some of the other headline risks that people were talking about. Do you agree with that? That this is just sort of the trajectory of the economy that a lot of people were looking past at the end of last year?
I do. If you look at the labor market, which really has been the key pillar of strength for the economy, it's been on that cooling trend for the past 2 years. So the economy has been moderating, but it's been quite robust. If you look at, overall GDP growth, the economy has been really outperforming its peers across advanced economies. But we've seen some moderation. When we look at the consumer on aggregate, we've seen consumer spending continuing to move forward at a solid pace. But we still have high interest rates. We still have elevated prices, and that's putting downward pressure on consumers' willingness to spend, especially for consumers in the lower income brackets that are feeling more of the pinch from these elevated interest rates and still high prices.
Lydia, in response to John's question, you were talking about how sometimes consumer sentiment doesn't match consumer spending. Sometimes what they say and what they do are two different things. How has that changed over time? The usefulness of some of these consumer sentiment surveys that right now are whipsawing the market, as we saw yesterday.
I think they're complementary. We look at the soft data to really get a sense of, what business sentiment is, how consumers are feeling, how they're reading the economic backdrop. The consumer confidence data has an important gauge on the labor market and the labor market differential, which is a gauge of, how they're seeing labor market opportunities. So we do get some good indication of what, how things are evolving in the economy. When we think about consumer sentiment, we have inflation expectations, which are really an important gauge that the Fed is also looking at. It's been moving up. So it does tell you that consumers are looking at these tariffs and they're thinking about the potential inflationary impact. So the soft data is important, but the totality of data is really what we're looking at and really the fundamentals for the economy.
One point that stood out to me from yesterday's survey was the share of consumers planning to take a vacation the next 6 months declined to the lowest level since April of 2021. Do you think service inflation could potentially start to come down quicker than maybe even some were expecting?
So, when we look at the inflation picture, our view has always been that this economic environment we've been in, this cooling trend we've seen in the economy is disinflationary. In that, consumer demand has been moderating, pricing power has also decreased from, 2 years ago. And when we look at housing inflation, it's also come down. So when we look at services inflation overall, it's been on that moderating trend. Now, if you look ahead at, the next few quarters, we're expecting the economy to ease back towards that 2% trend pace. And that means that, inflation should remain on a moderating trend, at least in the near term. But as you've been talking about, we have tariffs that are, looming, and they are going to have an impact on inflation. So inflation is likely to remain somewhat sticky on the back of these tariffs. But really, looking at the economy, the fundamentals are still disinflationary. It's just that we have those upside risk to the inflation picture and that stickiness that we've seen in recent months that are really leading the Fed to be on the sidelines for the moment.
They might be brought back in before they know it. Lydia, thank you. Lydia Boussour there of EY on the latest. This administration is moving so quickly at the moment that everybody else is hitting pause. And we heard that from Bank of America yesterday. We heard it from BMO as well. I'll share the quote from BMO CEO, Darryl White, who said, "We're seeing some clients effectively hit the pause button on some of their commercial activity." The head of global markets over at Bank of America, Jim DeMare, a listener and follower of this programme, I know. Jim, good morning to you. People are, I would say, waiting to get more information to make further adjustments to their portfolios. A lot of people are hitting pause, and a consumer to some extent is as well.
Which is a reason why there has been some modicum of caution by some of these executives. Where they're not pushing pause is maybe at work. And to your point, I wonder how much vacation time is going to suffer, given the fact that things are moving really quickly and everyone's trying to keep track of them and not miss anything. So I wonder what Marriott, Tony Capuano, good morning. I wonder what he thinks about all of this, the fact that, some of us are kind of hitting the pause button on those plans.
Yeah, manager, good morning. I'd like to take some time off, but it seems almost impossible with this administration. But to Jonathan's point, it's not just the high-end individuals who are invested in portfolios. The CEO of Lee and Wrangler Jeans yesterday saying this is a consumer that's confused. They don't know if they should go out and spend. And then they also said, and this is someone who sells you jeans, they also said that consumers are worried about their jobs and their job perspectives. And I think that starts to shift the conversation a little bit more.
Let's get the market conversation. Meghan Robson of BNP Paribas joins us now for more. Meghan, good morning.
Good morning. Thanks.
We're seeing a little bit of nervousness in equities, and I stress a little bit. We're still several percentage points away from all-time highs. Are you seeing any concern in credit and credit spreads at all?
In aggregate, no concern in credit. We've been extremely range-bound since the U.S. election, so within 5 to 7 basis points for U.S. IG, for example. And really the key drivers, despite all of the headlines that we've seen, you still have one very strong technical picture. Yield buyers are supporting the market. High yields prevent supply from rising too much. And then fundamentals are still very solid. Look at fourth quarter. We saw double-digit earnings growth for IG issuers. And so I think investors for now are focusing on those two features rather than tariffs.
Let's unpack fundamentals first and talk about fundamentals. What's the greatest threat to fundamentals at the moment?
We think it's a drop in earnings. So in order to really see high yield interest coverage get to a problematic level, which we think is around 3.5 times, it doesn't take just higher rates where we are now. You really need that drop in EBITDA of 10% or so. So the combination would really be the perfect storm of having higher rates and also a drop in earnings. But we do think the growth slowdown is a bigger threat for credit than elevated rates.
I thought your point there was really interesting about the fact that rates are high enough that you won't see that supply shock that could potentially send yields or spreads much wider. I am wondering on the other side, though, the demand side, whether you're seeing some potential buyers from, say, Japan fall off the map a bit because yields are rising there. I mean, there's some interesting sort of divides that are reversing the trend that have been in place, that has been in place for many years. Has that started to ebb, some of the foreign demand?
So foreign demand, to your point, is a risk this year as you continue to see the front end of the U.S. rates curve elevated. So hedging costs for those Japanese investors are still quite high, and then JGBs are rising. So that trade-off between USIG and local Japan bonds is shifting a bit in favor of Japan. But for now, we haven't seen selling of USIG. I think it's a risk to watch, but not a trend that's taken hold.
One thing we've been talking about all morning is sequencing of policy. And right now we're talking about tariffs. We're talking about some of the potential cuts to the government later this year. People are expecting that maybe we'll get the reprisal of those deals that have been put on hold, the sense that maybe that will come back to the fore. Do you think that that could introduce a whole host of supply? If there are a lot of mergers, acquisitions that do get done, is that going to be funded through the credit market?
It could be. I think one interesting point is in your discussion earlier about the negative sentiment. So credit markets are not pricing in risks of this, but you are seeing the uncertainty play out in some areas. So look at IG supply for February. This could be the first month where we are actually below consensus expectations. And what's really interesting about it is following the election, you saw this boost in optimism. You thought you were going to see animal spirits, tons of M&A, and that really has not happened yet. So I think treasurers, CEOs are sort of holding back in that activity. Should we see more certainty later on in the year, I think some of that could pick up. But for now, it's something that we haven't seen so far.
People are wanting certainty when it comes to tariffs. The president this morning is saying, just let it all happen, talking about these tariffs potentially on the auto sector. What do you think, in terms of industries, are going to be the most vulnerable?
So we do think it's going to be a sector story. Our base case, we're assuming around a 40% tariff on China, 5% rest of the world. Those would be implemented gradually. So in aggregate, we think that's manageable for credit, but there are certain sectors that really stand out. So I'll highlight two. In USIG, we think autos is very vulnerable, very intertwined with Canada and Mexico. We don't think that's fully in the price. And then in the high yield market, building products. Think about tariffs on things like steel. It could be a tremendous challenge, which is not in the price at the moment.
Can we finish on autos? I won't name the name. How would you feel if an auto company came out and sanctioned a big buyback right now on the equity side? How would you feel about that?
Well, definitely not my area of expertise.
But for someone who's nervous about investing in auto credit, would that make you more nervous?
Sure. I think that, if we see releveraging and sort of people increasing their balance sheet in a way that is concerning, it just adds to the list of worries for the auto sector.
Trying to keep you out of trouble, all right? Meghan Robson of BNP Paribas. I'm not trying to get you in trouble. Of course, GM earlier this morning putting out a new buyback, $6 billion.
Oh my goodness!
Well, we've moved on from the conversation, just not to Meghan, right?
Yeah, fair.
Coming out with a $6 billion buyback, the stock is up by something like 3-4% last time I looked in pre-market trading.
Your question's a good one, which is longer term, how will this be perceived by investors at a time of great uncertainty when potentially a stockpile of cash might be useful? This is typically a historically active time for share buybacks. Companies are getting rewarded, but it does leave a question about vulnerabilities in the face of a hold of
credit to them. They believe in the plan, they believe in the outlook, and the stock has declined substantially from the highs of last year. I think they're down about 20%, 20-odd percentage points. They want to buy the stock where it is.
Yeah, maybe they don't believe that the Mexico and Canada tariffs are going to go on, and they're just basically getting ahead of that.
Well, the CFO says they're going to be agile. and the need to respond to public policy.
I don't think many people believe those tariffs go on at all based on those conversations we're having. And by tariffs, I mean specifically the tariffs on Mexico and Canada of 25%.
You have to remember that USMCA is up for renegotiation at the start of next year. So that's why everyone thinks this is the start of a process for conversations on a trade deal that Trump himself signed off on in Trump 1.0.
Those tariffs, of course, set to go on next week. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump said he's starting a new path to U.S. citizenship. The president said the U.S. will sell gold cards for $5 million to foreigners who create jobs. He said the plan would launch in 2 weeks and that he doesn't think that it needs approval from Congress. Bank of America is rolling back workplace representation targets and diversity references. It added language like talent and opportunity in its annual report to replace the word diversity. It cited new laws, court decisions, and Trump's executive orders. Bank of America, just one of the latest Wall Street firms to cut back on DEI initiatives. And some more trouble for airlines. A Southwest Airlines plane narrowly avoided a collision at a Chicago airport as a smaller jet crossed the runway when landing on Tuesday. And a United Airlines flight carrying more than 200 people was forced to make an emergency landing due to a mechanical problem in New Jersey, that according to authorities. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Thanks very much for this morning. Up next on the programme, we'll set you up for the day ahead. We'll go through the day ahead, look ahead to NVIDIA and get the latest from Washington, D.C. From New York, you're watching Bloomberg TV. $40 minutes away from the cash open. Equity futures right now positive by 0.4%. We're on a 4-day slide. Let's see if we can snap that a little bit later at the close. Here's the trading day. It looks like this. Today, President Trump signing executive orders at 3 p.m. Eastern time. And then the big one on the earnings front, NVIDIA earnings after the closing bell. Thursday morning, another round of jobless claims, US GDP and durable goods, plus UK Prime Minister Keir Starmer visiting the White House. And Friday, core PCE. A busy day in Washington still ahead as well. Let's head down to the nation's capital and catch up with Bloomberg's Tyler Kendall. Tyler, what's on the agenda?
Well, John, at 11 a.m. Eastern, President Trump will convene his cabinet for their first meeting, and White House Press Secretary Caroline Leavitt confirms that Elon Musk will be in attendance. She did deny reports that some of these cabinet-level officials were caught flat-footed after the Department of Government Efficiency had put out that email over the weekend asking federal employees what they did last week. She did give us some data, though, said that 1 million workers had already replied to that request. That's about 40% of the federal workforce. What happens to the rest of those workers will no doubt be one of the topics of discussion during that meeting today. And we should just quickly add for context, while this cabinet level meeting typically includes those 15 cabinet level officials, it's not necessarily unusual that a special advisor would be there. We're also expecting White House Chief of Staff Susie Wiles to be in attendance as well.
Tyler, when it comes to this Ukraine minerals deal that Zelensky is expected to be in the White House on Friday, Caroline Leavitt right now on Fox News is saying that the minerals deals will be signed this week. Volodymyr Zelensky about 20 minutes ago said they're still mulling it over. What's going on right now when it comes to this relationship and this deal in particular?
Right. Well, we know that negotiations are still coming. Our Bloomberg News reporting saying that sources familiar say that Ukraine really looked at this original framework kind of as that first step. And we know something that they are looking for are more concrete security guarantees. And it kind of pitches forward to tomorrow when we are expecting UK Prime Minister Keir Starmer to also come to the White House, considering that we know that Europe would also like to see some sort of guarantees from the US, particularly as they put forward their own plan for a framework when it comes to European peacekeepers on the ground. So still a lot of different negotiations happening here as these two sides try to come together on a deal.
You're in the Capitol right now. How challenging has it been for some members of Congress, particularly Republicans, who were so staunchly backing Ukraine and really calling Putin an aggressor, to now deal with a Trump administration that really wants to try to push Putin to the negotiating table?
You're exactly right. And when we've seen some of these more defense policy hawks criticize this, they're not necessarily criticizing this White House. They're trying to criticize Vladimir Putin. We're seeing them walk this really careful tightrope here. But we have to remember that Ukraine aid has long divided the House conference here on Capitol Hill. And mainly this past year, it was really spearheaded by President Trump's now vice president, then Senator J.D. Vance, who's one of the staunchest opponents to supplemental security assistance to Ukraine when that debate was happening about 1 year ago today.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Thank you. This market very focused on the economic data at the moment, from you, Mitch, to the Conference Board consumer sentiment. Those kind of data points don't typically move this bond market around in the way this bond market has been moved around in Friday's session and again in yesterday's session. Jobless claims tomorrow morning, 8:30 Eastern time. Really, really important. Are we seeing any weakness there whatsoever? Because so far, it's been pretty decent still.
So the noise is going to be about parsing through which counties got particularly hit from some of the layoffs. The signal is going to be if there is a material creep upward in both the unemployment claims as well as the ongoing claims that are being paid out. If that is the case, it just fits the narrative too well for people to ignore it and probably will have a pretty significant effect.
I still think about the average of last year per month, north of 35,000 individuals added to the NFP once a month on Friday because of those federal workforce. Interesting what Virginia is doing. Governor Glenn Youngkin coming out with a portal to say, here are the private sector jobs that if you lose your job in the federal government because of DOGE, that you can go and apply for.
Payrolls just around the corner. It's going to get more and more important, isn't it?
Well, at a time when people are seeing consumer confidence about jobs go down. I mean, I think that that's really what caught people's attention yesterday. And we heard that from Yelena Shulyatyeva earlier, that the people who believed that they could get a job versus not went down significantly based on previous responses. So you put this all together and it goes to weakening but not weak, softening but not soft. You know, what inning of this baseball game are we in?
Cooling but not cool.
Exactly.
We can go on and on.
Well, can we? I don't know. I think I'm out.
Maybe I'm out too. Jobless claims, we're almost out. We're against the clock. Jobless claims coming tomorrow morning, 8:30 Eastern time. Later on this afternoon, of course, we'll look out for some more executive orders from the President of the United States. You'll hear from him a little bit later. Then after that, after the close, of course, the big earnings report is Nvidia. So looking out for that too. The team will run you through the close a little bit later on this afternoon. Coming up tomorrow, we'll catch up with Chris Ferrone of Strategas. We'll speak to Torsten Slock of Apollo, Binky Chada of Deutsche Bank, and Lauren Seidel-Baker of ITR Economics. The big one, just around the corner.
Yeah, and right now, not only payrolls, not only jobless claims, but Nvidia. Are we going to come in tomorrow and are we just going to be saying, hold on, everything is over because Nvidia came out and they didn't raise earnings? I just am wondering.
It's nearly always beat and raise, beat and raise, beat
I know.
and raise.
So what if it's not? What if it's
see if they sing a different tune?
Beat and hold.
A little bit later.
Game over.
Look out for that after the close. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance. From New York, this is Bloomberg.